Mr. Chairman, members, I appreciate the opportunity to be here today. I have an amendment, number 897. I think probably ought to offer that up to begin with to get it in the correct posture.
Okay. Let us get that amendment first. All right. Senator Gaddy opens up or brings up the amendment. Is there any discussion of the amendment? Senator Gaddy, did you want to say anything? You don't have to. Okay. Is there any opposition to the amendment? Without opposition, that amendment is adopted. Go ahead, Senator Luneau.
All right, thank you, Mr. Chairman. Members, this legislation is brought in an effort to lower insurance rates in Louisiana. We have had lots of discussion already this session about things that we could do to help lower rates, but quite frankly, I question a lot of those instruments that are out there as to how they're going to lower insurance rates in Louisiana. In fact, I think many of them are going to increase cost, which typically does not lend to decreasing rates. However, this particular bill will decrease rates. It's aimed at primarily three categories, and it deals with scoring on insurance policies for rate setting purposes. In Louisiana, we allow, first of all, rates to be set according to gender. I wasn't aware of that, quite frankly, and I've been pretty involved in this process for 4 years, and before that I was involved quite a bit in different organizations like LIGA and being a lawyer and working these committees for lots of years, but I never was aware of that. And it was brought to my attention by a constituent who told me that they were with a gentleman who was an actuary, previously an actuary for the insurance industry, and he showed them how to go to a website to purchase insurance, and they could get a quote on that website. And they put in information that was identical in address, age, automobile, occupation. Everything was identical with one exception, and that was gender. And one was for a female and one was for a male. And the female was charged approximately 30% more in premium than the male driver the same age. And this wasn't a teenager, but it was a person, if I remember, it was in their 30s. But the age and everything else, every other category was the same except for gender. And I think that's wrong. I don't think that people should be charged higher rates based on their gender. So that's one thing this bill does. Let's talk about the amended portion next. The amended portion was brought to my attention recently from reading an article that dealt with it, that talked about a widow or widower penalty. And apparently, when a person's spouse dies, they can also be charged higher rates. And again, I don't know why that would be actuarially sound other than to charge higher rates. So I'm asking that that be removed as a way to score rates in the insurance industry. And finally, perhaps the most controversial of these three deals with credit scores. So I'm going to spend a little bit more time on that one and talk about it a little bit more in depth. Louisiana is one of a few states that allow credit scores to be used in ratings for automobile insurance. So what does that mean? It means that if you have a good driving record but a bad credit score, your insurance is going to cost more. But even more astounding to me, I guess, was a headline that I read that I want to read to you. It says, in Louisiana, auto insurance charge wealthy drivers with a DWI staggeringly less than drivers with a spotless record but poor credit. So a person that has poor credit but has a spotless driving record pays more than the same person that has a DWI. That doesn't make a lot of sense to me. And look, maybe there is some correlation. The insurance industry has put out information. They put out a flyer dealing with this bill that says that that they have independent auditors and insurance companies that they have information that shows that credit history is a proven, accurate indicator of how likely a person is to file a future claim. Well, I've never seen that. If it exists, why aren't they waving it up here and saying, here it is, here's the empirical data? I've never heard of it, never seen anything like that. But they say it exists, so I would challenge them to let us know what that data is. I would be really interested to see if it's something other than what an insurance company has put out. If there's any independent entity that has put out information that has empirical data that shows that correlation. Some of the reasons that people have poor credit scores really don't have anything to do with credit at all, and we've talked about those issues at various times throughout the years. One of the reasons a person can have a moderate or a lower credit score is because they have no credit. I remember I had an uncle, and he wasn't a credit person. Didn't want to owe any money. He was a very religious man, and he thought that he shouldn't owe money, and so he never had credit throughout his life. And later in life, he had an opportunity to buy some land, and he was going to have to borrow some money. And he had a low credit score because he had never had any credit. So how does that correlate to higher insurance rates? Why should that person be punished that way? There are a lot of other reasons that a person can have a low credit score as well. For illness. If people come in and have an illness and they're financially strapped, sometimes they get in a situation where they can't pay their bills, and it makes their credit score go down. ID theft. It's one we hear about all the time. People have their identification stolen, and it's used, and it ruins their credit. So they got to pay higher insurance rates. Again, how is that fair? And what about a person that just loses their job? The company that they worked for shuts down or moves to another state, and all of a sudden they're in a bind, and their credit score goes down because they're late making their payments because they don't have the money to pay it. And then finally, one that I hadn't even thought about that was brought to my attention recently. People get out of school, out of college now, and they have incredible student loan debt. Lowers their credit score automatically. Even if they pay on time, the ratio of debt to their income is not right, and it lowers their credit score. Now, there's a lot of empirical data out there that shows that credit scores can drastically affect the amount that that consumers will pay for insurance in Louisiana. In fact, some of that data is found on websites of various insurance companies that indicate what these drivers pay. Now, we hear a whole lot of information about Louisiana is the most expensive state in the nation for automobile insurance. And then there's some other entities that say, well, we're number 43 in the nation. But it's suffice it to say that our rates are high, no matter what ranking we are, for 50th or 43 or somewhere in between. One of these entities is Wallet Hub. It's a internet-based thing, and lots of folks in the insurance industry use these internet-based things. But Wallet Hub has recently done a study that shows Louisiana drivers pay an average of 60% more and as much as 135% more for insurance if they have poor credit scores. So that's the purpose in me bringing this bill, to try to lower these rates when they're unjustifiably inflated because of credit score, gender, and being a widow or widower. I'll be happy to answer any questions.
Senator Long.
Thank you, Mr. Chairman. Senator Luneau, thank you. I think some of the points you've made are easily defended. But I do have a real issue with the concept of your perspective on some of the reasons why insurance companies, here's what we know. We know that underwriting is complicated, but it's necessary. This is another fact that we know, that about 80% or 85% of all poor credit ratings are the results of poor management. It may well be tied to some of the things you alluded to, and I do think that when a college student comes out of college, many times parents have incurred tremendous debt, as well as the student. I know where you're going. I'm trying to figure how to get there with a balanced approach to this. Look, we all pay insurance premiums, and they are too high. But I'm just wondering, though, how do we regulate an industry that is as complicated as this? And there are multiple factors that come into it. You make a great point, however, on the gender and the male, female, widow, widower, this type of thing. But I'm struggling a little bit with the overall concept. I'm not sure that what you're proposing will eventually lower insurance rates. Now, it may, but I wanted to to let you know that credit scores, in my opinion, is a legitimate red flag that companies need to look at. I think those with very low credit scores have a propensity to file more claims. I think they have a propensity to see the policy in a different way. So my question is simply, how do we move beyond this? Because I do think my real issue, as you can tell, is that we still have to underwrite the business, and money management is an essential part of how companies, and this is true whether you're dealing with J.C. Penney or whether you're dealing with State Farm. There is a certain need to be clear that a person's financial management does affect his habits, his likely propensity. That's my concern, not the other issues that you mentioned, but I think insurance companies still have to have the ability to underwrite based on all these factors.
My response to that, Senator Long, would be that I too thought a lot of things when I came here to the legislature. I thought people would, when they came to this table, wouldn't sit here and lie to you, but I found out they do. I found that people make up things and say this is this and that's that, and often that's not the case. The one thing I can tell you that I agree wholeheartedly with you is that the insurance industry is incredibly complex and incredibly minute about how they function. I don't think that's a coincidence. I think they do that on purpose. I think they don't want us to know this information. I think these guys came to this table and opposed Senator Appel's bill because they don't want to give us information in a manner where you can use it in a way that would expose what they have. I'm not against insurance companies making a profit. I want them to make a profit. I'm a lawyer. I'm in the business. I make claims against insurance companies all the time. I want them to be able to pay those claims. But I want to be fair with the citizens in this state. There's a reason why most states do not allow credit scoring in insurance rates. And the reason is because I think the average Louisiana citizen believes their insurance rates are determined by their driving record. They're determined by the kind of vehicle they have. Those are the type things that people believe insurance rates are set on. And that's a small piece of the puzzle. When you see a person, insurance rates go up from 60 to 135% because of a credit rating, that's a problem. Now, if they go up 10 or 15 or maybe even 20%, maybe that's reasonable and you can justify that. But if a person has a perfect driving record and their rates are higher because of a poor credit score than the same person who has a DWI, a proven problem driving, that's problematic and that's not fair. And that's what this bill is about, is it's about fairness.
And I agree with that premise. But I'd like to ask, where are you getting the numbers on the 60 to 100% increase?
That's from wallethub.com. It's another entity just like these. There are several entities that rate insurance across the nation, and they rated Louisiana. They say we're 46th in the nation in cost and premiums, and they did studies to determine these rates and how they're set.
Okay, thank you. Thank you, Mr. Chairman.
Senator Johns.
Thank you, Mr. Chairman. Jay, I agree with some of the things you have said, particularly that it's complex. I've been in this business for 37 years, and tell you what, there's nobody at this table wants to see rates go down more than me. As I was explaining to Senator Ward a few minutes ago, as rates go up, I lose business.
Yep.
If Company A can sell it cheaper than Company B and still make a profit or even break even and rely on investment income for their profit, they're going to do it. They're going to sell it. Somebody's going to come in and buy the market if they can, and I see that all the time. I see small companies come in, they buy the market, try to buy it for a year or two, jack up rates or leave the state or whatever, and then their policyholders are sitting out there in a lurch sometimes. I will tell you that I disagreed with something you said there about females being more expensive than males, because my experience is just the opposite. Male teenage drivers to insure are more expensive than female
Typically, that was my understanding too.
drivers, and that's based strictly on on statistics. It's not like, okay, we're going to charge male drivers more than female drivers because they're little boys or young men. They have more wrecks. As I tell my clients, it's not a matter if your son or your daughter's going to have a wreck. It's when are they going to have a wreck? And that's, I mean, that's, we've all had children. We've all gone through that. I've been through it. You've been through it. It's part of life, I guess. But there is, in terms of gender, there is a statistical reason for that. And so I have to disagree with you on that. I think it's a valuable tool in pricing the model out. Credit is a complex issue. It's not about whether you can pay your bill or not pay your bill. It's about who's the better risk than the other person. And that's a whole nother discussion that we have. I'm sure the opposition is going to come to the table to discuss that. But I wanted to particularly address the gender issue because...
Well, I'll tell you what I'm going to do for you, Senator Johns. I'm not going to tell your wife you said that, but anyway, I honestly thought, as you did, that it was the other way around.
Yeah.
Male drivers would be charged more, but I was shown on the website where you could put in your information and they would give you an insurance quote over that. And,
Well,
it
I
came
only
up that
represent
way.
one company. It's the largest company by far in the state. But
By the way, they don't charge a widow or widower tax either, your company, so I commend you
right.
for that.
Thank you very much. I appreciate that. So, but it is a fact that it's just based on statistics. So, thank you.
Yes, sir.
Senator, I don't have any more questions at this point, but you have someone here in support who would like to speak, and I'd like for him to come up, Mr. Robert Kleinpeter, LAJ. And while he's coming up, there are others in support but did not wish to speak. I believe that's Myra Winsky with Louisiana Coalition Against Domestic Violence, Taylor Robinson, Louisiana Coalition Against Domestic Violence, Ann Sturr, Executive Director, NASW of Louisiana, Sarah East, I think that might be Nelson, with Louisiana Partnership for Children and Families, and finally Matthew Sandifer, who did not put who he represents, but he is here in support. And Mr. Kleinpeter, whenever you're ready.
Thank you, Mr. Chair and committee members. My name is Bob Kleinpeter. I'm here on behalf of the Louisiana Association for Justice. We have hundreds of thousands of clients that we represent across this great state and small businesses, and our members are small business owners. All of us in our association are very interested in lowering insurance costs for not only our businesses but for our clients, small businesses, and for our clients themselves. So, how do we go about this? Everybody's interested in lowering insurance rates, and this bill, LAJ, is full and fully behind. We give our support to it because we think it's important for consumers to be charged on how they drive and not on who they are. We understand that insurance is complex. That's why it needs to be regulated. That's why it needs to be controlled. This legislature, like 49 other states, with the sole exception of New Hampshire, requires citizens who choose to drive to have insurance, and that's a good thing. But because that insurance is mandated, it's not a choice. It's not a you have to do it. You don't get to choose whether you want to buy insurance or not. It's a requirement. So because the demand is mandated, okay, the supply should be regulated, and the supply needs to be regulated in a way that's fair. So we can't have unfair discrimination, okay, right? We can have fair discrimination. So if you are a poor driver with traffic tickets or history of DWI, or you have a lot of miles that you travel, or you buy a new car and you want full coverage for comprehensive and collision and those type of other metrics, all of that makes perfect sense. so you should be charged a higher premium. What this bill does, and it's an excellent start, and other states are doing this, is it does not allow unfair discrimination on these certain factors. And this is happening, and it's causing our citizens to pay unfair amounts based on who they are and not on how they drive. Let me give you, for instance, the credit score is one I know that Senator Johns mentioned he's having difficulty with. And you know, the credit score, the way I'd like to explain it is the insurance that's purchased is not a loan. It's a product. I mean, it's just simply you either have it or you don't. I mean, it can be set up on a payment plan, and the insurance company can cancel that policy if you don't pay the premium. So it shouldn't be based on this idea, like, well, you know, we're going to give you a better rate than somebody else because, you know, we like your credit history. What happens a lot of times with a credit history, it's about bundling the products together. And that's part of the business model of some of these insurance companies. And that's fine. You know, if, say, for example, State Farm wants to offer lower car insurance rates to a wealthy person because they are going to bundle, you know, their duck camp or their second home or their trailer or their, you know, more cars or whatever, well, that's fine. I mean, they can do that. But they shouldn't penalize good drivers who are simply poor. And that's what we're trying to get at in this bill. It's not fair to penalize our citizens because they're poor. We do have high poverty in this state, and this is a real problem. And as Senator Luneau referred to, there's, I mean, literally there's over $100 a month, or sometimes up to $2,000 a year can be affected by your credit rating alone, especially in the larger cities like New Orleans and Baton Rouge. I mean, those are simply the numbers. Now, different companies weight it in different ways, and they do their algorithms differently, and those are proprietary and whatever. But the insurance commissioner, I mean, you know, if the insurance commissioner is not allowed to call a rate excessive if the market is called competitive, which is what the law is right now. And a lot of times, you know, the market is called, it's competitive, or it's competitive but challenging. Well, and he can't do anything about it. I mean, something needs to be done. So we suggest that the credit score should be given a real look by your committee. Also on gender, and before I leave credit score, it has been banned in you know, California, Hawaii, Massachusetts, I mean, across the country. And before we go, well, California, you know, why do we care about California? Well, they have had the lowest rate of insurance rate increases in the last 30 years of any state. So that might be a good state to look at for some of their practices. On gender, disproportionate impact in Louisiana because Louisiana has the greatest income disparity between females and males. We have the largest income disparity in the nation. So when we charge a gender more than another, that unfairly impacts them. We want citizens to be insured. Why? Because taxing the poor through too much insurance scoring for whatever, you know, gender, marital status, occupation, credit score, means, and if it's not related to driving, which it's not related to driving up and down the roadway or your miles or how you drive, it's who you are. Well, then that tempts those people to not buy insurance who are financially strapped, which then puts more burden on us who are paying our premiums. So it's one of these vicious circles. And then the last, I do want to touch briefly on what Senator Luneau mentioned, the widow's tax. I was on the High Auto Insurance Rate Task Force with Mr. Chair, and you know, we talked a lot about tort reform, and there was consumer complaints, but we didn't really get into the insurance rate making part of it. So I wrote some letters to the Department of Insurance, and I got, and I'm not being critical of anyone, I just didn't get the responses that I thought the subject deserved. So I had to go outside and consult some consumer associations, and I found out about this this widow's surcharge, and it just didn't. It just seemed, not to make any sense. But I was speaking with my paralegal, and her mother has a husband who died 3 years ago, and she told me, she says, my mom has to keep my dad on the insurance because her agent said her rates will go up 15% if she says that it's for her and not for him. That's just not right. I mean, and so the point is these are real problems. I mean, people are paying more money simply because of some kind of status, not having anything at all to do with how they drive. One other point with the surcharge, because poor people struggle because we require them to have insurance to get back into the market. If they, let's say they're being honest and they go, I just can't afford the insurance. I got to pay the rent. So they park their car, and then they want to get back into the market. Okay, so they're trying to do things in the right way. I mean, that's what we want. We want to encourage people to do things in the right way, to follow the law. We want to incentivize them to do the right thing. So they're doing the right thing. Then they get penalized. A surcharge placed on them because they're coming back into the market because they let their insurance lapse. Is that something we want? I mean, that's not even a part of this bill. I'm just saying there's a lot of things out there that we can do and we should do, and this bill is a great start to it. And it's okay. I don't mean to be pedantic. I'm saying it's okay for us to regulate insurance companies. Yes, we all want them to make money, but we want them to make a reasonable rate of return. Not picking on State Farm, Senator Johns, but State Farm has decreased rates 3 times in the last 9 months, according to Commissioner Donlan, who I worked with and was listening to his testimony. 7.7% they have decreased it in the last 9 months. Now the rates that they got, those larger rates, I mean, they're not, where are they going to go? I mean, they're not going to come back, huh? I mean, not going to be redistributed. And why were the rates higher to where they felt they had to cut them 7.7%? I mean, that's a lot of money. Commissioner Donlan said anything over 5% is a lot of money. Well, that's 7.7% in 9 months by the largest insurer in the state. Last point, we need to make sure we're talking about apples to apples. Liability-only policies, Louisiana's not second in the country. They're not the second highest in the country. When we talk about second highest in the country, you're talking about this sort of exemplar policy that has like liability and collision and comprehensive. Well, think about what happened in August 2016. We had 60,000 vehicles that had comprehensive that got into the system after the record, the whatever 500 or 1,000-year flood record, and are now in the system. And that made our rates go up. Well, I mean, what can we do about the weather, right? I mean, you can't legislate the weather away. So my point is, I mean, we really need to look at, with a laser focus at what we're doing. We need to be data-driven, really data-driven, and not just be guessing, and not just indulge our prejudices. I mean, everybody here is in good faith. Everybody wants to do something about it, but we all bring our own perspectives. And LAJ closes and submits that there are real things that we should do to help our citizens, and this bill's a great start.
Thank you, Mr. Kleinpeter. I have some questions for you.
Yes, sir.
Senator Lambert.
Mr. Kleinpeter, I agree with a lot you're saying. I think your rate should be based on your driving record, and some people drive better than others, and that, if your rate was based on your claims history. But my problem is, how do you determine a rate when you have no driving record? Like you take, for instance, like and I'm going to just use this as an example. My wife was the parish judge in Ascension, and we were talking about young male insurance rates. And, I got to talking to her about it. She said she's never had a female charged in her traffic court with drag racing. You know, and most of the times you see young males take more chances, they drive faster. So, I mean, I can see that gender would be a basis in maybe setting insurance rates because they look like they appear to take more risks. Would you say males sometimes on past history drive faster?
I'm not here to defend the teenage brain.
Well, I mean, no, but but I mean, part of that is
I raised it. I've got a 22-year-old son.
And you were a 22-year-old once yourself, as I was.
I did things that I.
And worse yet, when you were an 18-year-old, you probably were a little bit more reckless.
Agree.
So, but I mean, I think we have to base it. It's a very complicated, issue basing rates. But I mean, you have to look at a past claim history, and if these people are driving faster when you initially set their rates, I mean, shouldn't that be a factor in determining rates?
Well, I mean, there's meta-analysis of the demographics, and there's the driving habits of citizens, and what pigeonhole do you put them in? Do you put them in like 16 to 25, or do you break that graphic down from 16 to 20? I mean, you can do all those kinds of things. I guess the point is, do we want to equalize things to some extent? Because in some ways, women are being charged more for driving based on their credit scores, okay, and based on.
Well, look, I
their
agree. Credit
scale.
scores.
So if we equalize all of that, I mean, we can equilibrate the whole thing. I mean, I think that's the bigger point. Do some of us have to suffer a teeny bit so that the whole system together, since we all have to be insured, is going to be fairer?
Well, I guess when you say some of us may have to suffer a little bit, well, then that gets away from the claim history claim, because I want to pay insurance based on my claim history or whatever. If I have a good driving record, I don't want to have to pay, more. But so I mean, it's a complicated.
And that would be agree that we should be charged on how we drive, not who we are. So if we enter the system and we're just an X factor, and we don't get tickets for 3 years, we don't get into wrecks, and we don't get any kind of substance abuse arrests or moving violations or what have you, then I mean, we should continue to go on and not be charged extra. Agree.
Okay, but how do we get to that 3-year history where we can determine what rate we should be paying?
Well, let me tell you. Let me respond to that if you don't mind. The issue here is that they're charging based on gender. That's a factor they use in there, because when everything else is equal and one gender pays more than the other, that's clearly what that's based on. If the address is the same, occupation is the same, credit score is the same, all those things are equal, and the only variable is gender, then that's the reason for a higher rate. And in a 30-something-year-old, that's not a factor. Now, a teenager, I understand it's a factor there. Typically, the way that's done, when you can't consider one of those things, you can't consider gender, they consider age. Now, would it lump males and females together? Yes, it would. And I understand there are not a lot of females that are drag racing out there, I used to have those hot rods back in the 70s, and I understand that. But at the same time, there are females that get into wrecks, maybe more so than males. I don't know the answer to that. But if you start using every one of these factors and you continue to use them, even when they've exited one risk factor, and you continue to use those to base higher rates, that's what you're going to get, is higher insurance rates. So you have to draw the line somewhere. When you see, and you hit the nail on the head when you said it should be based on what kind of vehicle you have and your driving record when you have an established driving record. Those should be the major two components in there, and it's just not. Incidentally, I went back and looked at my notes a little bit when I told y'all before about the entity that reported that a person with a DWI had lower insurance rates than a person with a poor credit score in Louisiana. That's from a little company called Consumer Reports. Y'all might have heard of them before. So that's not from the insurance industry. It's not from the trial lawyers. That's from Consumer Reports. That's not fair. That's a proven driving record. Somebody got out there on the road when they were intoxicated and got charged and convicted of this crime. They have a driving record that shows they're not reasonable, they're not responsible. Why does a person that can't pay their bills for whatever reason, whether it was they were a poor money manager or whether they have some illness or whatever the reason was, it shouldn't be that way, and that's one of the problems we have. Is this bill going to fix all of our ills with insurance in Louisiana? No, sir, it's not. But it is a step in the right direction, and I can tell you what I firmly believe based on the data is that it will lower insurance rates in Louisiana. And isn't that what we're trying to do?
Oh, I think we need to lower rates, but I'm not sure. I think it's such a complicated situation. I'm not sure if this lowers them or not, or it just makes it more complicated. I mean, the perfect world is your claim history. But the problem is, until you have a record, you don't have a claim history, and they have to set it at some point. And maybe that's what needs to be looked at as to how, after you're driving for so long, that maybe we need to have, some kind of checks and balances in there to where you really are looking at your claim history.
But the factor they can use there when you don't have a driving history is age, and the rates are higher for the younger drivers. So
there's no question.
So they do have a factor they can use there when you don't have a driving record. It's not like they're having to just set rates arbitrarily based on nothing. They can use the age factor, and they can use the location where you live, any number of things. And look, those are legitimate factors in my mind, because if a person lives in a rural area, there's not near as much traffic as if they live in downtown New Orleans. I mean, and increased traffic,
less chance of a wreck,
distracted driving, all of those things factor. So I understand those. But credit score, gender, and widower,
I can see credit score is a different animal. That's all the questions I have.
Okay, thank you. Let's get some other questions. Senator Long.
Again, thank you, Mr. Chairman. Mr. Kleinpeter, I lost a wife 2 years ago. One of the comments you made is that widows, those who have lost a spouse, are likely or will see an increase in rates. That has not occurred. That is the first time, I have to tell you, that is the first time I have heard that rates go up based upon the fact that a person lost a spouse. Can you give me more information on that?
Yes, sir. I believe, Senator Long, it's in 4 out of the 6 insurers do that in Louisiana.
if you have State Farm, they don't do that. They don't.
State Farm does not. Let's see if I can find for you. Yeah, 4 of Louisiana's 6 largest auto insurance companies increase rates for people who have lost a spouse compared with what is charged when they are married.
And can you tell me what those 4 are, those companies?
I can, if I can read quickly. Yes, sir. State Farm and Farm Bureau do not. Geico, Allstate, Go Auto, and Progressive do.
Okay, so it would seem to me that the industry is split on that. So my Senator Luneau, my question is: obviously, all companies do not use the same parameters for determining rates. This is a clear example that 4 companies. But keep in mind, in Louisiana, there's 4 companies, but there's probably over 200 that write property and casualty business in Louisiana. I'm just saying that as I mentioned to you previously, I like the concept of trying to figure out how to lower, but I think it's far more complicated than some of the things that we've been able. But thank you for that.
It is complicated, Senator Long, but if we don't take some steps somewhere in some direction, we're never going to solve this problem. If we throw up our hands and say, this is too complicated, we can't deal with it, we're going to have what we have today, and that's some of the highest auto insurance rates in the nation. Okay. If we start taking some steps to lower that, and that's what the people of the state want. And look, I'm not saying that this is the cure. There's a lot of things we can look at, but unfortunately, this has not been one that we've been looking at lately. We've just been talking about tort reform.
Right.
And we got to do tort reform. Well, guess what? we've done tort reform, and my rates didn't go down. You know, I remember sitting in this committee back in 1996, hearing Senator Don Craven Sr. say, "I've been here all these years, and all I hear is the insurance rates are going to go down if we do this tort reform, and the insurance companies are going to leave if we don't." And I've never seen a rate increase. I've never seen a rate decrease since I've been here, and I'm the same way. In my lifetime, my adult lifetime, I haven't had any insurance rate decreases of any significance. I've had a lot of increases. So we can either throw up our hands and say it's too complicated, we can't do it, or we can try to fix a few things at a time. And the fact of the matter is, some of those things we do don't always work. But we're never going to know unless we try. And I think these are some common sense things that will help us go in the right direction.
Thank you. Thank you, Mr. Chairman.
Senator Gaddy for a question.
Thank you for your testimony today. There's a bill called the Omnibus Premium Reduction Act of 2019 that passed the House yesterday. Are any of these topics within that bill? Does Mr. Luneau's bill duplicate what's in Representative Talbert's bill that you know of?
Well, I'm familiar with HB 372, and it's my understanding that a lot of the four tort reform efforts in that bill came out of the High Auto Insurance Rate Task Force, which is, again, the focus of the task force, despite a presentation by Louisiana Department of Insurance on factors such as weather and impaired driving, distracted driving, roadways, and such. It was all about litigation reform, and you know, consumers complaining about high rates.
Let me ask you a different way. I mean, did y'all talk about this stuff for the year y'all had that commission going?
We did not, and
Talk about the widowers, 4 out of 6 charged widowers or widows more.
we did not.
Did you
Senator
talk
Gaddy.
about age or gender being used, or credit scores, or buying power, any of that?
No, sir. We didn't talk about the rate-making process or how rates are evaluated or how the insurance companies view the rate-making process or the regulatory process itself. That was not a subject of study. It was all about what happened in the courtroom, not what happens in the rate-making
How many
process.
meetings did y'all have?
We had 3 called meetings. I attended all of them, and the last meeting was in November. And I began writing letters in January because I had additional questions, and we never had another meeting.
So did y'all discuss, if you didn't discuss credit report, can you tell me from your experience, man, how hard it is for someone to repair their credit after they've been the victim of identity theft? Is that something easy that people get to do? Or is that a tough situation to have all the credit scoring places help you repair your credit?
Well, that's a great question. Number one, it's my understanding that credit score that the insurance companies use for auto insurance is not what we all commonly think of as credit score, like with Equifax or, you know, these other these companies that keep credit. They have their own system, so it's assembled through some kind of complex algorithm that they look at your shopping habits and what have you. So the credit score is something that the insurance companies assemble, and it's not transparent, and it's not shared with the consumer, and it was not a subject of study by the task force.
Well, I've asked agents in my area about this bill, and they said, we don't know if we use credit score or not. That's not something the agent does there at their office, is it?
It's my understanding that a credit score would be something that the actuaries would fold into the rates, and that's a fairly complicated and niche type area. It's a very highly specialized area. There are not many actuaries out there. More to the point to your question about the tort reform that was in HB 372, and to me this is the critical part of that. Again, everyone here wants lower rates. Everyone here indulges their own prejudices we bring into, I mean, naturally, because that's who we are. That's how we're built, and that's our life experiences. But the idea, I had hoped, would be to have a data-driven analysis of the rates and where are we having problems and what can we do to fix the problems.
And I don't mean to interrupt you. I know we're got other bills on the docket. But I guess my question is, I have a logging company in my area. They have no claims. Okay? But when they go to buy their policy, I'm sure they ask for the owner's buying power and credit score and those things, because it is a captured market. It's tough to buy those things. Do you know whether or not those insurance companies are using my constituents' buying power, credit score, or gender to increase or decrease his rates?
I have no clue.
But they're not restricted from using that, correct?
I'm not privy to that information. I just don't know. I mean, I simply don't know.
Because he told me they asked him how much money he makes.
Well, I mean, there you go.
And is that something that's prevalent throughout the industry?
I would defer to the insurance agents that articulate between the consumer and the insurance company. But I mean, those are the types of things that insurance companies seem to be evaluating, and different companies evaluate in different ways. Again, the chief actuary for the Department of Insurance was unable to give us any savings that would come from the 4 tort efforts that are folded into the House Bill 372.
And was the actuarialist from the commission asked to, in any way, to look at Senator Luneau's bill to make a determination if it would lower rates or not?
Not to my knowledge. I mean, I would have liked to have asked those questions.
And was that brought up at the Omnibus Premium Reduction Act committee?
It was not. The High Auto Insurance Rate Task Force did not analyze actuarial data which applied to credit score, marital status, gender. No, sir.
I mean, it was my impression that we wouldn't have all these bills this year. I mean, Senator Appel had a bill yesterday in Juday. Senator Luneau has this bill today. There's several other bills that are kind of coming through that are insurance reduction bills. And I think what you're telling us today, that a lot of these bills weren't discussed for the 3 meetings that y'all had with the committee.
Well, I'm never surprised by the creativity of the legislators, and I'm just a citizen here testifying. But yeah, there were many things, Senator Gaddy, that we did not study, and we did not discuss, and we did not analyze and compute and calculate the rates for at the High Auto Insurance Rate Task Force Committee.
So is it possible for us to do tort reform and it not reduce rates?
Well, according to Mr. Piazza with the Department of Insurance, I mean, we don't have any metrics on what these 4 tort reform efforts in HB 372 are going to do. And we've certainly never calculated anything in Senator Luneau's SB 89, the bill under discussion. I mean, the bigger question is, can they calculate these? Because maybe they can. But what we do know for a fact is that they can't do anything with the House Bill 372 tort reform efforts. I mean, there was no, they can't give us any information.
So are you saying that actuarialists for the commissioner admitted that there's no hard data on whether or not 372 would reduce rates or not?
Yes.
Okay. And that the same actuarialist was not asked about credit score, gender, widower, status, buying power, any of those other things during the times the commission met?
The actuary was not asked to compute any of the last information that you just listed, to my knowledge, and I listened carefully.
Because a lot of folks back home, they're reading the title of 372, they're saying omnibus, and that means everything was talked about, that anything that could lower rates is in that bill. But you're telling us today not everything that could lower rates was considered or within that bill.
Yes.
Okay, thank you.
Senator Johns for a question.
Thank you, Mr. Chairman. Once again, Senator Luneau, you weren't here then, but some of us at this table were involved in a piece of legislation that did lower rates, and it was called No Pay, No Play. And it actually, that bill mandated a 10% reduction in BI rates at that time. So that was in the bill.
The rates went right back up after that time period.
And based upon actuarial experience, but we did, we made an effort, and I was one of those I mean, the insurance industry wasn't thrilled about mandating a rate reduction, but we said, okay, if you want this, you got to have this, and so I was one of those that kind of pushed for that mandated reduction, and so we've tried all kinds of things. So, I wish.
Yeah, Senator Johns, I agree with that, and the no pay, no play was one of those.
Yeah.
But I can tell you, overall, with a few dips, automobile insurance rates haven't gone down in Louisiana in decades.
No,
in decades, they have not. So the things that we've tried have not been successful. And I guess the thing that gets me is it's always focused on we got to do tort reform to lower insurance rates. And we've done tort reform, and it's not lowered insurance rates except for a few dips. So why not try something else? Why not look at this and see if this works? Let's give this a shot and see how much this change rates. You know, when you're looking at like these people reporting, 60 to 135% more because of credit score. If you take out credit score from that equation, some of those rates are going to go down. If you take out gender, some of those rates are going to go down. If you take out the widower tax, some of those rates are going to go down. I can't tell you. I don't claim to be an actuary. I can't tell you how much. Nobody can tell you how much. But I can tell you this: the rates will reduce if they can't use those factors. And you look to the other states that have done this and taken away those factors. It reduced rates.
Well,
now,
I don't know if I'd use California as an example. You better go look at their rates out there. If you think we're in bad shape on rates, it's just outrageous in California. So, that's reality. So,
well, and I can tell you this: they're not as outrageous as we are because they're lower in rates than Louisiana is by just about every one of these standards. In Louisiana, the various companies that analyze this say we're somewhere between 50th and 43rd. So. And California is lower than that. So look, I don't know if that's accurate or not. I can't tell you. A lot of these are internet sites, but they're cited by the insurance industry, so that's what we have to go on. The NAIC, I believe, is the acronym. It's an industry. It says we're 46 in the nation. It's a pretty good fact.
If we can ever figure out a way to take this out of the hands of a driver. You're going to see rates go down.
You are exactly right. And again,
it's amazing.
That's one of those things that we need to look at.
How many accidents that I see, text messaging, it's in the police report. They were text messaging. They were returning emails. They were on the internet or whatever.
I was driving home from here last week. I left Baton Rouge, and when I got on I-49, and I'm driving down, and I'm passing a car, and all of a sudden the car just starts veering over into my lane. It runs me off on the shoulder, and it was a lady on her phone texting, driving down the road. So
I admire your efforts. I'm not quite sure it works, but I admire your efforts.
Thank you. I appreciate it.
Senator Lambert.
And I just want to follow up on that a little bit. I mean, really, the whole problem is if you didn't run into somebody or cause a wreck, you wouldn't have the claims. It wouldn't be the.
Yep.
I mean, that's what it boils down to. People are texting. You have vehicles that are much more expensive than they used to be. And when they're damaged, it costs more. It's part of the reason for rates. Mm-hmm. So I don't have any. I mean, that's basically if we quit running into each other, we don't have the claims. And hopefully the rates will go down. So.
Senator Ward.
Thank you, Mr. Chairman. I'm going to be brief. I know we need to hear from the opposition, but I do appreciate the fact that you brought something that at least it appears as though from some third-party resources we have something that shows that if we at least take a look at it, it has seen some significant increases or decreases, in insurance rates as opposed to some of the other things we have out there that it's kind of, I don't know, I was reading last night some different comments about other bills that it's, citizens are like, oh yeah, just trust us on this. We've seen that out of the legislature before. Just trust us. Help us pass this and just take our word for it that it's going to be all right. And so, we should be a little more data driven, a little more statistic minded in our approach, and so I appreciate the fact that at least you bring something with some numbers that back what you're trying to do. A lot of times, much of what sits at the table in front of us is politically motivated and not numbers motivated. And so I think this is something we should look at hard from that reason alone. So I appreciate that. I know we need to hear from the opposition.
Mr. Chairman, I saw when I came in today, I saw my bill up there with all those red cards. I thought those were Christmas cards that the folks were sending me, so I was excited until I figured out what they really were.
Well, they may give you something for Christmas. Speaking of opposition, if you don't mind, let us have them come forward. Mr. Kevin Cunningham, APCIA, and would like to speak. Jeff Albright, independent insurance agents and brokers, would also like to speak. Please come on down, gentlemen, while I read the other cards in opposition. Joe Mapes, Louisiana Farm Bureau. Rodney Braxton, State Farm. Kevin Ainsworth, Progressive. Sandy Mapes, Louisiana Farm Bureau. E.L. Bubba Henry, State Farm. Jody Boudreau, I think that's PIA, and Alicia Duan, Adams and Reese, all are present and opposed but do not wish to speak. Kevin, would you like to go first?
Mr. Chairman, members of the committee, Kevin Cunningham again representing APCIA. We are a trade, we are a trade organization. We represent about 60% of the entire U.S. market in insurance, and also that holds true for Louisiana also, roughly maybe 58% in Louisiana are members. We represent several of the largest companies that you've heard of. It is a combination of two. In the past, I've always come here and talked about AIA as my client, and there was also another trade organization, PCI, we combined recently, and that's why you have APCIA. There's a lot to unpack based upon what the previous testimony that was given. There were some statements made that just are entirely inaccurate. First, I need to start with the fact that this bill does not change behavior at all. I think Senator Johns talked about if we could take phones out of people's hands while they're driving. That's a change in behavior. That will absolutely change our claims experience. This bill does nothing to change claims experience. The same amount of money coming in claims will still be out there, whether or not you use credit, whether or not you use gender, whether or not you're chasing a 2-year-old, or even maybe an older than a 2-year-old goes with widows. Widows or widowers. Most companies, probably 80–90% of the market, don't even look at that anymore. So that's an old ghost that we don't necessarily even chase anymore, but or utilize anymore. It's been at least 2 years since I think it's most companies have even included in their rate filings. But on credit and gender, you're not changing behavior, and that's what changes rate structures. That's what changes claims. What you're doing in this case, is you're just shifting who pays it. I'll go through a lot of this. You asked for a lot of that. Everyone wants data and all that, and you've got a lot of good data out there. But first and foremost, you've got a good bill out there already. A good law out there already. We faced this bill, these type of legislation, probably since I started in 2000 doing this type of work. And it has always come up. Finally, in 2005, Senator Boissier passed the current law, which is your use of credit information. And it answers just about every one of the questions that Senator Luneau brought up with that particular client. This is the INQO model that we adopted here. 28 other states have adopted and still use this same model. That's what you have on your law, on your books right now. There are a number of things. What it tells us is there are a number of things that insurance companies cannot use to set when they use credit. They can't use medical bills, even collections on medical bills. I'm trying to look for that section now. works in the front here. Yeah, use of medical accounts in 1504. You can't use collection accounts with medical industry code if so identified on the consumer credit report. We can't use that. So if somebody had got their credit dinged as a result of it, we can't use it. There's a dispute process that you currently have in your law that allows for somebody to come in and say that's wrong, the report's wrong, and you have to change it. And we have 30 days to make that change. There's an appeal process in the law that if you think that your underwriting risk has been improperly rated as a result of credit, you can come in and appeal that to the insurer. And lastly, there are exemptions to credit information. This is out of your current law. Insurers shall provide reasonable exemptions from the use of credit information in underwriting or rating risks if the consumer can clearly demonstrate that his credit history is unduly influenced by a medical crisis, death of a spouse, identity theft, the personal guarantee of a business loan, or a catastrophic event as deemed by the Commissioner of Insurance. You have a very good law in place as to when and why, where you can use credit. So let's look at why do we use credit in the first place. Our indications show that it is a better predictor of risk and claims experience than most things out there. And it's just not me saying that. You ask for a number of reports, or you ask for data, not just from the insurance companies, as to where this, why the use of credit is important. I'll go through a list of them. Georgetown University Law Center, 2013, concluded that credit-based insurance scores do not act as a proxy for income. So if you come here and you say that poor people have poor credit, that's just wrong. That's not always necessarily the truth. And the fact is that it's not income dependent also, the use of credit. That answers one issue of unfairness. Colorado Division of Insurance, January 2010, did a report, found that the use of credit was a good predictor of risk and an indication of the propensity to file a claim. St. Ambrose University, 2009. Conclusion was, we think the current evidence of predictive power of insurance credit is overwhelming. Federal Trade Commission in 2017, they were required to do a study on the use of credit. They are predictive of the number of claims consumers file and the cost of those claims. In 2005, Texas did a report. Credit score was related to the experience even after considering other commonly used rating variables. There are a host of reports out there, not just the ones I've cited, all show that use of credit is predictive of future claims experience. Finally, as far as the reports are concerned, 2012, your own Commissioner of Insurance had conducted a report. And that report was required by an HCR 46, which actually required the Commissioner to look at reports of insurers' practice of credit scoring. This report is available online. I pulled it off online, and I asked if you're really interested in the subject, if you really aren't interested in finding out why the use of credit works and why it is predictive, I ask you to look at that report, because that report comes to the same conclusions, that it does, that credit and the use of credit is important for to predict future claims. Part of this report was conducted by Tillinghast, which is one of the largest actuarial firms in the world. You ask for more data. They are probably not a group of people more data-driven than actuaries. They found that the indication of the relationship between insurance bureau scores, and that's what we're talking about, and the loss ratio is relatively is high. Loss ratio relativities is highly statistically significant. So we're not guessing when we say that the use of credit is important to us, because it is predictive of behavior. That allows us to put the right rate with the risk. Higher the risk, the higher the rate. The lower the risk, the lower the rate. That's what we're trying to get at when we set insurance rates. It's an underwriting tool that we use. I want to talk a little bit about gender. There was a lot said about gender and whether or not who uses it and who doesn't. I think there's only 5 or 6 states that just disallow gender altogether. We're not one of them, obviously, because there is a correlation between gender and propensity to having to file a claim. But that's really only at the levels of 25 years and below. And that's because there's a number of factors on gender. Typically, I think Senator Lambert pointed out that there is a disparity as far as driving behavior and driving habits for those 25 years and below. That's primarily because statistically, men are in a much higher risk of having the number of accidents they have, speeding, and DUI. And this is at the 25-year and below. So after you start getting older, that averages out, and it ultimately evens out, and it's impacted and shows in the rates that are ultimately approved by the Department of Insurance. So there is a difference in the use of gender, by using gender in certain situations. Quite frankly, if you disallow genders to be used, all you are doing is raising the rates for women 25 years and below, because they are no longer to take advantage of that differential that they have in rates. So, as I said earlier, none of this absolutely changes behavior, and therefore you're just shuffling who pays it, and that doesn't tend, in my mind, doesn't seem to make sense. When you are able to, again, put the risk put the rate where the risk is, and all you're doing is obscuring the insurance company's view of where that should go, but they still have to pull out the same amount of premium to cover the claims that will still happen. None of this changes the behavior, and therefore that will absolutely, it will not impact rates, but only, again, changes who pays it. One other thing I wanted to point out as far as credit, everyone seems to not like the use of credit because they think it adversely impacts most people. It doesn't. One statistic that I read, 89% of the people either benefit or have no benefit from the use of credit or have no adverse impact as a result of it. It's about 12% of people with bad credit that are actually dinged on their insurance rates as a result of that. And again, for those who think that is unfair or that it is improperly applied, you have a law in place and you have a procedure in place that would allow them to attack any unfair use of that credit if they think it is inaccurate or there was exceptional circumstances. I'll stop there. Again, it's probably a lot I could say, but I'll let these other two gentlemen talk, and if anyone has any questions.
Thank you, Mr. Cunningham. I think Senator Ward has a question of you.
A few questions. Thank you, Mr. Chairman. I know a few times you mentioned behavior. Do you think trying to do something to change behavior of drivers, is that in your mind the best way to lower rates?
That is a way to lower rates, by changing the behavior. Absolutely.
What are some things across the country? Has there been any other state that's implemented something that has just seen rates just?
I think it's a misnomer to ever really believe that your rates are going to go down. There's so many pressures for it to go up. Medical costs continue to go up. The cost of a vehicle continues to go up. The amount of wages that you have to compensate somebody for continues to go up. So maybe what you do is slow the rate of rise, but to say that you're going to have something that makes the rates go down when there are other factors that bring it up is somewhat difficult. But to answer you, to try to get to what I think your question is, yeah, distracted driving. That's a great one for
So
behavior.
we're really misrepresenting to the public when we sell them something that says, "Hey, let's do this. We're going to lower your rates." We might slow down the rise, but chances of them waking up next year to
you may lower the rates for that particular segment of your policy costs, but you're not necessarily. I mean, all those. If you're not addressing if you're not going to address how much a car costs, you're not going to necessarily. If a bumper might have been $200 now. 20 years ago, now it's 5,000 because of all the cameras and all you have in it.
and
So,
and there's nothing we can do about that. That's just a cost that continues to rise.
I'll leave that statement alone. I was going to say, if you take the tack that you do sometimes with insurers and try to force them into do something that may be that may actually increase their cost or lower their profits, yeah, I guess you you could do something.
Yeah, I mean, I guess we could make you a utility company and say we cap
Monopolize,
your,
right?
Yeah,
right.
we cap your
Your
profits
ROI
at X percent.
Not sure whether or not we would necessarily oppose that. Basically, if you give us the same utility rate of return. If you give us a utility rate of return, we might take that one.
But I guess my point is like almost anything, whether it be a gallon of milk or a loaf of bread, the cost in things continue to rise. So for us to sit here on any particular bill and make out to the general public like we're going to pass this and you're going to wake up a month from now to significantly lower rates is really kind of silly and a big misrepresentation, quite honestly.
Is there a question?
Yes.
There are factors that will be positively impacted as a result of passing legislation that changes behavior. Thank you.
One of the things you talked about was the fact that there's a law in place right now on the credit score, and that there's a way for somebody to appeal that.
Yes.
Is that made known to that person?
Yeah, I think there's actually a requirement. If you do an adverse, if you've taken an adverse action, and this is more in the Fair Debt Collection Practices Act, I believe, but it comes in here because of the use of credit. If you take adverse action, as a result, you are required to notify the individual that you have taken adverse action and the process to
That is correct.
to clean that up.
So like if I would have, I don't know, let's say I walk in to get a policy and had a, my monthly rate would be $200, but had my credit score been a little bit better, it'd have been $150 a month. Are they required to tell me that, or would I've just had to figure that out on my own?
You would have, if that's considered, I believe that's considered an adverse action. If a rate has gone up as a result of the use of credit, then that is an adverse action, and that's when everything else kicks in.
Okay. And the reason I ask that is, a lot of times in theory there are appeals processes, but unless the person knows to take that appeals process, it's almost not worth the piece of paper it's written on.
Yeah, I understand.
And so that's why I'm asking. I just want to make sure that people know that it's available to them to be able to say, well, hold on a second, I'd like to look into this and see what's causing that part of my metrics or whatever you use to come to my premiums, what's holding me up there. And
now, if there's, and I would just argue that, well, not argue, but make the statement that's, if you feel that can be improved, I think that's where the improvement should happen, but not necessarily just outright saying that you can't use credit because you don't like the
Right.
fact that there's not a good appeal process.
So I guess one thing that comes to mind is, and maybe it would be something we could look into amending is, like for example, with UM or not UM, you have the UM rejection form. And so maybe we could look at doing something like, well, hey, if you're going to have to pay 25% more, 20% more based on something on your credit report, you got to sign this, letting you know that you were made aware of it. It was just something I was thinking about. Another thing that I wanted to ask about was, are rates for individuals, do you come to that based on a risk that they'll make a claim, or a risk of, do you look at the risk of them making a claim, or a risk that they may get in an accident?
Not sure if I understand. Well, I think I do. I believe it's a little bit of both in this, and you're getting probably a little bit above my pay grade relative to exactly how companies set those rates. But I believe a good portion of the discussion, at least as far as the use of credit, and most of this is trying to predict where your claims are going to come from. So some of it is predictive, and some of it is a look back relative to what has been your claims experience in the past and what we believe it will be in the future. So to answer your question, I believe some of it is related to your propensity to make a claim. In an automobile insurance, you would only make a claim when there's an accident, generally.
So if and the reason I asked that is because whenever you have two people, if you just are looking at comparing two different people and you have one that's been in a couple of different accidents and somebody that's never been in an accident, and the person that's never been in an accident ends up with a higher rate, that would make me think that what's looked at or weighed heavier is some metrics that lets the company, the insurance provider, say, well, we're basing our rate on the fact that we think you're more likely to make a claim one day than this person.
Yeah.
Senator,
Mr. Braxton may have a...
Mr. Chairman.
Mr. Braxton, go ahead.
Yes, Rodney Braxton with Southern Strategy Group, representing State Farm Insurance. Number one, I want to apologize for not being here earlier. I had to be at the Board of Commerce and Industry, so that's why I was not able to appear before. So I just want to first offer my apologies.
Well, we did miss you, but
and listen, I felt the love all the way at the LaSalle building, actually, believe it or not. So I'm here to requite the love.
go right ahead.
Thank you. But Senator Ward, I'll do my best to try to answer your question, but it's more of a claim, and I'm not an actuary, but my understanding of it as it relates to the rate setting portion of it, gender and credit are just one of two factors that they use. There's several other factors that are used in setting a rate: location, the type of vehicle, etc. And it goes to the propensity of filing a claim more than anything, not necessarily of having an accident. There was a bill that that came through the process a few years ago, and it was really more about claims that were filed on vehicles that were vandalized, and that was really based on location of the vehicle, because there were issues where vehicles were continuously being vandalized, and we were unable to change the rate for a particular kind of vehicle because of that, right? And so we didn't have to replace the vehicle. It wasn't there were no bodily injuries or anything like that, but it was really based on where the vehicle was located, but it was a high risk. You follow me? And so, but location really mattered in that instance in terms of how we would set that person's premium.
Right. And look, I understand that.
Yeah.
I guess I was just trying to understand sometimes how you get. I mean, obviously, there's factors you weigh.
Sure.
But sometimes you wonder, how do you have somebody multiple accidents, you have somebody no accidents, but whenever you look at all the different factors, I guess maybe where they live, hey, folks in this zip code, they, their window gets busted out. We get claims for busted windows 3 times a week, so there's a good chance we're gonna have to replace a window for you. So,
Right.
I mean, there's other things. I understand those
Yeah.
those types of things. So, I guess kind of my last question, I'm gonna circle back. Do any of you believe that this bill or any of the other bills will lower insurance rates 3%?
If we're on this bill, as I said earlier, I don't think this bill will impact insurance rates at all.
How about
quite
any?
Frankly,
How about any of them out there in this session?
I would. Yes, I do believe that they will impact claims experience, which will then ultimately impact rates.
Make them go down?
And they will have a
Positive.
positive effect on. I know. I know where you're trying to put me, and
The
I'm just trying
specific
like hell not to be
specific question: will they make them go down? Because that's what. And look, here's what I'm trying to get at. Because this is the box we get put in as legislators. There's one thing that gets sold to the public, and then there's another thing that's the reality of it.
Yes.
And so I'm just trying to ask for the truth of the matter.
Senator, I think Mr. Albright has a comment on that
Right,
question.
and I
Mr. Braxton.
I was going to say, I want to say this: the bill that is coming over recognizes, and well, let me say this: insurance, and I think Mr. Lambert was pointing to it, and it's been mentioned here many times. It's a data-driven business. If I'm the first time I'm coming in and I'm a teenager, and Mr. Johns can tell you, and I have no driving record, my rate's going to be based on not what my 17-year-old driving record is, but what State Farm's experience is with 17-year-olds, period. Right? So the bill you have coming over has built into it provisions that will allow for review over a period of time because, again, insurance is an experience rated, it's based on experience. So after a period of time, we were required to go to the Department of Insurance and show them how the provisions of the bill has impacted our business. And if it impacted our business positively, we're required to react to that and adjust our rates accordingly. So, I mean, it's going to be very difficult for Mr. Cunningham to tell you any kind of number exactly because the bill hasn't passed and we have no experience. So, it's hard to tell you an exact figure or a number. Kevin, was that accurate?
Yeah, what he said.
Mr. Albright, did you want to comment on that?
Jeff Albright with the Independent Insurance Agents. This probably comes under the category of fools rush in where angels fear to trod. But I would also suggest to you that, as Kevin said, if we change behavior and we change the claims experience and we reduce the cost of the claims to the insurance companies under HB 372, for 3 years, the companies are required to file. And there was a big debate in my House floor about, well, what's a commissioner going to do? The imposition is not on the commissioner, it's on the companies. The companies must file their experience, and the commissioner shall reduce the rates commensurate with the improvement of the experience. In the House Civil Law Committee, Commissioner Donlin testified that he has historically worked on this issue a number of times. As a legislator, he brought bills. As a commissioner, he's worked with the bills. He believes direct action is worth 5 points, and he thinks that collateral source is worth 5 points. That jury trial threshold, they just don't know what that's going to do. They couldn't really put a number on that. So my personal feeling from looking at the experience, and here's the truth of the matter. I was on the high rate task force too. We talked about distracted driving and a lot of other issues. But when you look at the experience of the insurance companies, our accident rate in Louisiana is just slightly higher than the national average. Our property damage claim rate, how often we claim that the vehicles are damaged, are right in line with the accident rate. It's slightly higher than the national average. And therefore, the premiums on physical damage coverages are slightly higher than the national average. Where we are an outlier is in our bodily injury claims rate. It's almost double the national average, and we're in the top 5 highest bodily injury claim rate for the last 20 years. Well, it doesn't take a genius to figure out if you're in the top 5 states in bodily injury claim rate year after year after year, and you're making more bodily injury claims in other states, then those premiums are going to be higher than other states. So if we're able to change behavior, if we're able somehow to bring our bodily injury claim rate in line with the rates in other states, which would be less than it is right now, you would see a reduction, a probably one-time reduction, maybe over 2 or 3 years as the experience settles out. Now, over the long haul, does that mean insurance is going to be cheap forever? No, because of what Mr. Cunningham said. Cars are more expensive, medical's more expensive, wages are going up. But the goal, in my opinion, is to get us in the middle of the pack, to get us more reasonable with other states, so that maybe we're, number 20 or 25 of the 50 states, not number 1, 2, or 3.
Okay. Well, thank y'all for answering my questions. Appreciate it.
We do have one late one late card that came in, Ms. Phyllis Perrone. Louisiana Insurance Conference is here in opposition. Do we have any other questions? Senator Gaddy.
I just want to thank y'all for coming to the table and explaining this. And Mr. Cunningham, I want to thank you for always educating us every time you get a chance on these issues. I have one quick question just to make sure we're clear. Talking about credit scores, if someone has a high credit score, do they get does that make the rates go up or down? If any of y'all can answer.
Can I answer that?
Yes, sir.
One of the points that I was going to make, Mr. Cunningham did a great job and covered most of the things that I wanted to cover, but one of the things I wanted to cover is they do not use, insurance companies almost universally do not use credit scores. The 3 credit companies do credit scores for credit companies, for banks and credit card companies and everything else. The numbers
you're
that
about TransUnion, Equifax,
exactly.
Those guys.
600, 700, 800, credit scores. That's not what insurance companies do.
All right.
They have their own proprietary insurance score, if you want to call it that. And what they're looking at is various factors. It's not based on income. It's not based on credit. It's based on risk factors that credit shows. Basically what they're using is using how people manage the risk in credit to predict how they're going to manage their risk in their home or in their auto. Some people are very cautious and they manage risk very carefully. They're risk averse. So they're going to be very careful to pay their bills on time, to make sure that they don't apply for 10 credit cards at a time.
I mean, whenever y'all write policies for the state of Louisiana, you don't consider that, do you? I hope not. You don't consider unfunded accrued liability or anything like that, do you? Because that would be a.
But
is it possible to have a negative credit score? Because we might have that here at the state. So, all joking aside, I understand that y'all have a proprietary. We're just calling it credit score because that's
right.
the most relative term we have that will translate to how you calculate, formulate your data. My question is, if somebody gets an A+ on your standard, do they get a lower rates or higher rates, or how does that work?
My understanding, based upon the statistics that I talked earlier, it appears as at least 89% either have, well, when you factor in credit, I believe I'll break down the numbers. 39% actually have a favorable result on their rates when they use credit. Maybe 49% no impact on at all based upon wherever their credit score falls or their insurance score falls, and 12% actually have a negative impact as a result of when you factor in credit.
So the guys at the top, it doesn't affect them. The guys at the bottom, I want to make sure we're clear.
As far as credit scores,
it would
concerned,
it would increase their premiums, correct? Because they're a higher risk.
Correct.
yes,
Correct.
right.
And so I think earlier y'all might have testified that if this bill passed, it wouldn't really help rates at all. Is that
Yeah,
correct?
I still believe that.
Okay.
It does not. It just means maybe that 12% that's paying a little bit more, that they'll pay a little bit less, but the 39% that's paying more, I'm paying less, will pay a little bit more. It's just shuffling cards at this point. You're taking one group and subsidize it with another. It doesn't change behavior. It doesn't pull any claims out of the system. It doesn't lower any cost in the system because those same premium dollars still have to come out in order
Right.
to cover the claims.
Is your 89% number and the other numbers you talked about, are those nationwide or are those South Louisiana, North Louisiana,
And
just
that's
Louisiana?
why I always hesitate to use any
Right.
particular number because
I'm pretty sure there's a countrywide.
you think so?
I'm pretty sure there's a countrywide number.
I will get you where I got the information from if
Yeah, because I think if we're doing a comparative analysis and we want to know apples and apples here, I mean, if we all admit we have a very high number of people in our state that are Medicaid eligible that live below the poverty line, and I know that correlates with you can't borrow money and whatever credit score rating you're going to use, they're going to have lower credit. But those folks are mandated to buy car insurance. So do we have? Is there any correlative data where you could say what percentage of people are affected in Louisiana by a low credit rating from your proprietary software?
I will sure try to find that out.
Okay.
I don't have that now. But I also wanted to tell you that the bill that was passed in 2005, which is current law, does not allow insurance companies to ding you as far as credit, use of credit, if you have no credit. So if you have no credit, you're not going to be adversely rated because it's not going to be considered low credit or bad. It's not going to be considered bad credit if you have no credit.
Could you also get me the percentage of people that have no credit that apply for insurance? Is that something you can put your fingers on?
I will try. I just don't know some of that information.
Yeah, I think that would be
proprietary.
helpful because this is a year where we're trying to lower rates, and if we have specific data on Louisiana, I would appreciate just reviewing that. So I'm going to go back home and people ask me about this bill, I can tell them what our Louisiana numbers are. Thank you for your time.
Thank you.
Okay. Mr. Albright, did you have further comments? Mr. Braxton? Okay, thank you, gentlemen. Senator Luneau, would you like to close, please?
Yes, sir. It may be a little different manner than I'd expected to today.
That's your choice.
Just want to make a few comments first. I heard some things up here that kind of go to the reason I'm trying to do this. One of those things was that rates are set on the likelihood more than anything else that a claim will be made. Well, you know, there are a lot of claims that are made that aren't our fault. We have uninsured motorists because we have a problem with uninsured people here in Louisiana. But what's the likelihood we're going to make a claim? Does that go up because we have a bad credit score? Does it go up because you're a widow or a widower? Does it go up because of your gender? I don't know the answer to that because the next point I wanted to make was that they say that information is proprietary. That means we're not going to let you see it. But take our word, this is what it says. I've had enough of that. I've had enough of them saying, this is why you want to do it because of us. We're not going to tell you any of the reasons. We're not going to show you any of our data. But there are studies out there that support it. You know, there's the Georgetown University study. I don't know who funded that study, but sometimes that has a meaning in it. They say we have all these laws right now that protect everything that this bill is trying to do. We don't really use credit scores. We come up with our own credit score. Well, you know what? They're right. We don't know what they do. We don't know how they determine that because they do use their own proprietary information. So we don't know the answer to that. But what do we know is they do use it, and we know in some instances it can be over 100% increase in the premium. That came from Consumer Reports. That's somebody that I would allege to you doesn't have a dog in this hunt. They're not trying they're not associated with the insurance industry. So what do we do? Well, their answer is to change behavior. But what legislation have they brought this session to change any behavior? If that's truly the problem, why aren't we addressing that? All they want to do is address tort reform, and they want you to ignore everything else. I don't know of any other industry that's so completely unregulated when it comes to profits when we're captive to have to buy their product. And that's what we are in Louisiana. You have to buy liability insurance. We're captive to that. Every citizen that has a vehicle has to have it. This bill is not punitive. It's not about punishing any insurance company. I hear all the time, those trial lawyers, they just want to break all the insurance companies. That's the last thing anybody wants to do, because then we don't have coverage. And after all, isn't that why we buy insurance? So when it's necessary, we can make a claim and we're protected and it doesn't ruin us financially? That's the very essence of why we do it. And I told you this bill was not punitive, and it's not. I'm realistically trying to help adjust rates down. So this is what I'm going to ask you to do. I'm going to ask you to give me an opportunity to change some things in this bill that will address some of the concerns that the industry has, and frankly, some of the things that you've brought up here today. For example, after thinking about it, I think probably what we should do on the gender aspect, because most of the claims they tell us on the gender issue are 25 and below, I'm willing to work on an amendment to say 25 and below, they can use gender as a rate mechanism. I think that's reasonable after what I've heard today. I'd also like to look at an amendment that says that if you have a bad credit score and they determine that's going to be used in your rate setting, but you have 5-year history of good driving, no tickets, etc., then it removes it from the equation and they can't use that. I think that's reasonable. So what I would ask the committee to do is let me defer this bill for a week, work with the opponents of it on some amendments, and come back, have those amendments next week, and let's consider them and try to pass this bill out. I think that's reasonable under the circumstances, and I would ask for your indulgence to do that.
I can offer those amendments now if we'll save time.
Yeah, let's just wait. I think that's an excellent request, and I don't think there's anyone in the committee who objects to that unless there's some discussion. We will delay your bill for a week, and you can work with all the gentlemen and see if we can come up with some amendments to address their concerns.
We're going to work on it tonight. Mr. Henry invited me over to his house to have dinner tonight.
Oh, you're in trouble now. All right.
Thank you, Mr. Chairman and members. I appreciate it. This is an important
Thank you,
issue, and I
Senator
appreciate your
Luneau.
indulgence.
Thank you. Senator Luneau, as you're very well aware, we had a good discussion last week, and we appreciate you being here and coming so quickly when we call this morning. And if you'd like to just begin where we left off, and we'll start there and try to make it as expeditious as we can for everyone. We do have some amendments. I think you probably have some as well.
Yes, sir.
So if you would begin.
Mr. Chairman, I appreciate you getting me out of Health and Welfare Committee to be here this morning. When we left last week, I'd asked the committee to give me another week to try to work with some industry folks and see if we could iron out some of our differences. And I want to thank them for doing that, because we did meet and we were able to find a little bit of common ground, not a whole lot, but a little bit. And so that's very helpful in the process. So let me just tell you about what I would like to do and the amendments I have, and then we can go from there. I think our agreement lies in the area of what I've dubbed as the widow tax, or the widower tax. And I think that the industry doesn't have as much heartburn about that, so I think we're going to be okay with that portion of it. So what I would like to do is offer 2 amendments on the other 2 portions of the bill, and I've asked that they be done separately so we can vote on them, and if it's the committee's pleasure to report them in that manner, that's fine. If they don't, it doesn't kill the entire bill.
Okay. I'll offer up those amendments. You want to go directly to those?
Yes, sir. The first one is 1356. 1356 deals with the issue of gender. And when we discussed the issue of gender, it was brought to my attention in the committee meeting last week in talking to the industry folks that there is a need for the use of gender, especially as it applies to younger drivers who don't have a history of being licensed very long, and that's especially true with young males. And they're rated higher, and I don't have an argument with that. So what this amendment would do would say that if an insurer has attained the age of 25 years or more, then gender can't be used. The research that I have done and the folks that I've spoken to have showed me on various websites where males under 25 typically are rated higher, and that's, like I said, that's understandable. But then after they get above age, and I don't remember if it's 30 or 35, that females are rated higher, and I don't think there's any particular reason that's been assigned for that. So this amendment would say that that they can use gender up to the age of 25 for those younger drivers that don't have a history. I'd be happy to answer any questions on that amendment.
The amendment's approved.
All right. The next amendment is 1357, and that amendment deals with the issue of credit scores as a means of determining rates. I won't go back into all the detail we did last time about it, but credit scores are one of the things that make rates go up higher in Louisiana for some folks. In fact, one of the studies that was conducted that in Louisiana, it showed an average, if you look at an average premium on a baseline policy with a person with excellent credit, the amount is approximately $1,900. If you compare that to a person with the same driving record but with poor credit, the average policy was $3,548. So nearly $1,650 higher because of a credit score with the exact same driving record. If you throw in there a person that has excellent credit but they had a DWI conviction, their rate is $2,643. So a person who has a proven bad driving record and history, their rates are lower than a person with poor credit. Now, that's problematic in this state because we are a poor state. If I remember correctly, we ranked about 49th in the nation in that category. So it does present a big problem. The amendment that I'm offering on this says that credit scores cannot be used if the insurer has no record of driving infractions or has no at-fault claims in the last 5 years. In other words, if they have a good proven driving record for a period of 5 years, then they can't be dinged for the credit score. I think that's a fair compromise because especially if you have somebody that doesn't have a driving record, existing driving record, you can use things like credit score. But this, if the person, even if they have bad credit, if they have poor credit for whatever reason, but they have a proven good driving record, then they can't use the credit score. Now, the insurance industry has told me, well, all it's going to do is readjust rates and things of that nature and make some people pay a little more and some people pay a little less. But really and truly, isn't that what it should be about? Shouldn't it be about your driving, your abilities that you've proven, you've demonstrated? Shouldn't it be about the kind of automobile that you drive? I mean, does it really matter that you have poor credit for whatever reason? You know, and you know that they've told me, well, we have actuaries that people that do these algorithms and all this stuff that help us determine that, but it just doesn't pass the smell test. It's punitive to poor people because typically the poorer the people, the worse the credit score. Not across the board, but typically that's the way it works. So this amendment would basically just says that if you don't have any tickets, you don't have any claims with a 5-year period, good driving record, then you don't get dinged for a credit score.
All right, I do have one question. Senator Long?
Thank you, Mr. Chairman. Senator Luneau, couple of questions. Why 5 years? Is there a particular position on that?
No, sir. Actually, when I talked to the industry folks, I offered whatever amount of time they wanted. If they wanted 7 years or what, I didn't know. That's just an arbitrary number that I chose because they wouldn't agree with me on that amendment. They don't want to affect credit score, use of credit scores in any way in rating. Now, again, going back to my point, the reason I thought a demonstrable record of 5 years, and honestly, I don't care if it's 7 years or whatever that number is, but at some point in time, it really should matter what your driving record is.
But would you agree that credit scores is an indicator?
No, sir, I honestly don't. I tell you what I think, and a lot of people agree with this. Now, you know, the industry doesn't agree with that, but I think one of the reasons that they look at this is to lower the rates of people that typically would buy more insurance. Now, it's not true throughout the industry. It's not true in every single company, but in some companies it is. For example, if you have a person that has a poor credit score, a widowed person who has a poor credit score, typically they're going to buy a minimum limits policy. They're going to buy the smallest policy, and they have one vehicle to insure. If you have a person who is wealthier, which equates better with credit score, not always, but on the average it equates to a better credit score, they typically are going to have multiple vehicles and maybe even want a life insurance policy or a bank account or whatever the issue is, and it helps lower their overall rates so they're not paying as much. So it's a cost shift from one set of people to another. So I don't believe that it's indicative. Other states have prohibited this besides Louisiana, and it's, you know, and I understand Mr. Cunningham testified that this is not going to lower rates. Basically, he said nothing would lower rates, but I don't buy into that argument.
Right.
I
But
think that there's some things we can
you
do
do
to lower
agree
rates.
that this is contractual. It's a relationship between the insured company and the insured. Now, that's the same principle we use, and may I use a personal illustration? I hope it's okay with my wife. She has decided that she wanted to purchase another home that provided, perhaps more of what she wanted in a home. It was interesting, the amount of paperwork involved in processing that loan.
It's those lawyers, Senator Long. They screw up everything.
The lawyers tend to add a bit to it. But the bottom line, quite candidly, because of her outstanding credit rating, she received a lower interest rate. Now, I think that parallels personally with everything that we enter into contract with, is that a company has a right to evaluate at least a part of that underwriting. And by the way, it's only one of seven underwriting rules. I pulled up State Farm because they're the largest insurer in the state. I just believe, though, that I just have an issue with even though you use a 5-year rule, I think credit rating is a legitimacy part of underwriting a policy.
Well, let me respond to the points you made on there. The first one is when you discuss the entering into a contract, and it's a contract between the two folks. That's exactly what it is. The difference between buying a home and the contract you'd enter to in that instance and buying insurance is you don't have to buy a home in Louisiana. There's no law that says you have to do it. There is a law that says if you're going to drive a vehicle, you have to be insured. So it's a forced contract, if you will. You have no choice other than to break the law if you're going to drive a vehicle in Louisiana than to buy that. So that's why it's treated differently in one respect. The other one is, what if in the same instance your wife went to get her loan and she had great credit and she had good income and so therefore she had a good credit score and she should get the most favorable interest rate, but she likes to drive down here to Baton Rouge and go real fast, and she had a bunch of tickets that she got for speeding. And they said, well, you got speeding tickets, you have a bad driving record, so we're going to raise your interest rate. I don't think that would be fair either. And that's the correct analogy in this instance.
Well, nor do I, and I don't think that's part of underwriting a home loan.
It's not. But that's the point is it shouldn't.
But
that's
it
the
should.
opposite of what the
But it
argument
should
is
be if you're insuring a car because of the. Again, I know where you're coming, and I know you're hard on that. So thank you again.
Yes, sir.
Mr. Chairman, thank you.
Yes, sir. Senator Gaddy,
I'd offer the amendment.
Thank you.
is there any objection to offering up that amendment, Senator Gaddy? Without discussion, the amendment is adopted. Thank you. Thank you, Senator. What we're going to do is bring up the opposition, and would like to read a couple of cards who are here in support. And Stir, Executive Director, National Association of Social Workers, here but not wishing to speak, and in support, Louis Wren, Louisiana AFL-CIO, here in support but not wishing to speak. Susan East Nelson, Louisiana Partnership for Children and Families, here but not wishing to speak. Thank you for being here. The opposition, Mr. Kevin Kevin Cunningham, APCIA, is here and would like to speak. Kevin, if you could come up. And Jeff Albright, Independent Insurance Agents and Brokers of Louisiana, is here in opposition and wishes to speak. Sandy Mapes is here but does not wish to speak with Louisiana Farm Bureau. And Billy Yelverton is also here with Farm Bureau but not wishing to speak. And Tom Clark with Allstate is here and would like to speak. And Tom, if you could come up, he's here. Okay. And also after this, if we had another chair, I'd like to have him up here. But Mr. Piazza with the Insurance Commissioner's Office is here for information. And maybe we could get him up here. I'm sure we all need a little more information, Mr. Piazza. Jeff, would you like to proceed?
Yes, sir, Mr. Chairman. Jeff Albright with the Independent Insurance Agents. Since Mr. Cunningham took the lead last time, we thought we'd give you a little different face this time, and I'll kind of take the lead a little bit. I want to try to make this as quick as possible, but I do want to give a little additional, if you would, technical insurance background to the discussion. First of all, we want to thank Senator Luneau for trying to work with us on this bill. We were able to work out a couple of the points, but we are strongly opposed to the bill, primarily because of the credit scoring piece. Credit scoring is critical to the rating systems of insurance companies, and the companies have one system that they use nationwide. They have different rates from state to state in different areas of states. But if we prohibit credit scoring and tell them you can't use a system you use in almost every other state here, that's going to create some fairly significant problems. We absolutely agree with Senator Luneau that experience ought to be the primary driver of your rate, and it is. But you have to understand how rates are made. The vast majority of people have no tickets or accidents or claims. So the question is, how do you differentiate the premiums between the 75 or 80% of the people that don't have any claims experience? They all have a clean driving record. One's a 17-year-old kid that's most likely going to have an accident, and the other is a 55-year-old person who's probably not, because they're a more experienced, mature driver. You have to set base rates using all of the characteristics that insurance companies use. They use what vehicle you're driving. They use where you're located. Someone in New Orleans is going to pay more for their insurance than somebody that's located in Bunkie, which is the way it should be, because the claims experience is going to reflect that. So they set the base rates using all of these criteria, and credit scoring is a vital characteristic for that base rate. Once the base rates are established, they then apply the experience. If you have tickets, your rates go up. If you have accidents, the rates go up more. If you make claims, the rates are going to be higher because of that experience. So insurance companies absolutely use experience, as Senator Luneau wants to happen, and we do too. Everybody agrees that experience is critical to the rating, but you have to set those base rates using other factors. Credit scoring is one of the most predictive factors. Now, we keep saying credit scoring, and that's an absolute misnomer. It is not a credit score. It is an insurance score. The scores that we're familiar with, the 600, 700, 800 credit score numbers that the three rating agencies give, are not what insurance companies use. They use some of the characteristics that the credit companies track as measures of risk. Income has very little to do with it. We have customers who have extremely high income but take risky activities. They have way too many credit cards. They run balances way up on their credit cards. Those types of risky activities that the person participates in are reflected in the insurance score. It is not based on credit. Insurance scores are not driven like credit scores primarily by income. So that's a misnomer that I think you all need to understand. The vast majority of people, either the insurance score has no effect, about 38 or 40% get a better rate because of the credit score, and only 12% of the people get a higher rate, a worse rate, because of the insurance score. If you eliminate the use of credit, all you're going to do is shift the rate. The bad drivers will get a rate reduction. Hooray for them. The good drivers are going to pay more to offset that premium. You're not reducing the cost of the insurance companies. You're just shifting who's going to pay for it. This bill does not reduce overall costs. It's not going to drive down the overall rates. And maybe the thing I'll close with is the Department of Insurance. One of the things that people talk about, oh, well, they got these algorithms and we don't get to see it, and there's no transparency and we don't understand it. The Department of Insurance, and I think Mr. Piazza can speak to this, the department looks at all these factors. And if they're unfairly discriminatory, they make them, adjust them, or disallow them so that the rates are not unfairly discriminatory. If they discriminate correctly based upon risk, that's what they're supposed to do. And so the department looks at all of that, and they look at all of the factors, and they make sure that it's fair for the consumer. And I think that's probably the best thing that we can do. So I'll close there, and in the interest of trying to be brief.
Okay. Senator Ward has a question.
Thank you, Mr. Chairman. Just a couple of things. Something that I think has been said, I think it was said last week, and then you just said it again a minute ago, and it's a little concerning to me because as we try and do things that maybe make the rates go down, it seems like maybe that's kind of a far reach, but it seems like no matter what we do or what we attempt to do, what has been repeated several times is, well, we're just going to shift the rates. And so can you explain what exactly you mean by, well, if you make us do this, we're just going to shift the rates, or if you make us do that, we're just going to shift the rates? Is there anything that we can do to try and lower rates to where y'all's reaction is not, we're just going to shift the cost to somebody else and make somebody else pay more?
Absolutely. There's a distracted driving bill going through the process right now. If we tighten down on distracted driving and change behavior so that people don't drive as distracted as they are,
sure,
I think there's very little doubt that that's going to improve the experience of the insurance companies. They're going to pay less claims, which means their costs go down, and that will be ultimately reflected in reduced rates to consumers. I think that absolutely will help to drive down costs.
I tend to agree with that because I'm on the road a good bit, and I don't know that there's a vehicle that passes me that the person doesn't pass like this.
Exactly.
So,
lots of crazy people doing crazy things in their car. That would be a huge thing that we could do. And I think most of us agree on that, and so that's an easy one. One that is maybe a little more controversial is, I think everybody here knows, Representative Talbot has a tort reform bill that is aimed at trying to change the litigation climate. The reason that's important is that if you look at the accident rate in Louisiana, we're only slightly higher than the national average. So should we try to reduce the number of accidents? Absolutely. But we don't really have an accident problem. Our property damage claim rate, how often we claim our vehicles are damaged, is right in line with the accident rate. It's just slightly higher than the national average. Our bodily injury claim rate, how often we claim we're injured and need a check for our injuries, is almost double the national average. It's always in the top 2 or 3 for the last 20 years. It's way out of whack with everything else. Well, why are we claiming that we're hurt more than other states with similar accident frequency? Is it because we're more fragile and we get damaged more easily? I don't think so. I think we have something in our system, and we can debate about what those things are, but there are things in our system that encourage people to make more bodily injury claims. If we can do something, and again, you all will debate the policy of what the right things to do are, but if we could do something to get our bodily injury claim rate in line with the accident rate along with other states, that would dramatically reduce the number of claims, the expense to the insurance company, and rates are going to go down. So there are absolutely things we can do to drive down cost. This does not do that. All this does is say, here's a factor that the insurance commissioners around the country, independent studies, lots of different, independent from the insurance industry agree, are very good predictors of risk, but you can't use it anymore. And that doesn't change the experience. All that does is say, we got to figure out other ways to allocate the price.
So do you disagree with Mr. Cunningham? You believe that we can make the rates go down?
Absolutely.
Okay.
Can I comment?
Sure.
Kevin Cunningham with APCIA. You asked a very specific question last week. Was it last week? I believe, relative to the my belief in the rates, at whether or not I assume you're talking about HB 372 at that time.
No,
Or in
I'm just
general.
talking in general because we're on insurance, and I would love to see our rates go down.
I think the
just
rates, my comments, I'm sorry, I cut you off. Go ahead.
No, my question was very general. What around the country have you seen that has been implemented that made rates go down?
Right. And as Mr. Albright said, I do believe that there are components, there are things that you can do to bring certain components that make up your rates down. And consequently, though, but there's still also upward pressure from various other things, wages, medical expenses, the expense of automobiles that are pushing it up. So I don't want people to sit here and say, well, you said rates were going to go down because you do this overall. That's not necessarily always going to happen because you do have those upward pressures. You always have upward pressures because of inflation and all of the other things I just mentioned. So consequently, I want to make sure that you understand that, yes, I do believe there are components in our rates that can go down or at least stop and overall stop the higher the rate of increase that we're seeing. But just to sit here and say that, well, you promised us rates would go down if we did this, that's not necessarily always the case. Because there's always upward
There's no
pressure.
silver bullet.
Absolutely not.
And I
There's
appreciate
always no
that.
silver bullet. So-
And if there was, we could pass a bill that had some rate reduction included in it,
yeah,
and I'll go and move on.
or the opportunity to have the rate reduction, absolutely.
Right.
Yes.
So, okay, that's all I have for now.
Senator Gaddy for a question.
I want to thank y'all for coming back and working with Senator Luneau and on this bill. I just have a few kind of general questions. You know, you were talking about credit scores and if somebody has risky credit behavior. On the flip side of that, you know, I do a lot of family law, so I look at a lot of credit reports. And when we try to do credit repair and things like that for people, you know, we're told a lot of time by creditors that if you don't have any history, then you have a low credit score, and we see that happen a lot, especially when I had a title company. You'd have people come in who owed no money to anyone, and they wouldn't have a very good credit score because they had not been out in the market borrowing money, and even on a credit card. You know, some had their money in jars in the backyard. I'm not going to ask them where that was, and they didn't trust me enough to tell me where they were. But So I have kind of an issue with that premise, if it's in the logarithm of low credit or high credit or risky things, because students learn early on that if you don't go borrow some money to buy your first car, or if you don't show income when you work for the family business, then you can't have a good credit score. So sometimes if you don't have any credit card debt, if you don't run your credit operation, you know, in your household or your business that way, then if you pay for everything in cash, then when it comes time to buy the house or the car, they'll say, look, you don't have a credit score that's worthy of a loan. So how do y'all compensate for that when you have folks that have been coached or encouraged to use credit, and so they get into that credit bind, and not because of any risky behavior they have, because they were motivated to do that?
I'll take that one, Senator
Thank you.
Gaddy. In the law that was enacted in 2005, which is the INCOIL model on the use of credit, in 2005 this legislature enacted this model law relative to when you can and can't use credit. In 22-1504, paragraph 4, the credit score or the insurance score, you cannot take an adverse action against a consumer solely because he does not have a credit card account or other credit history without consideration of any other applicable factor independent of credit information. So the law that was passed in 2005 took that one into account.
So I'm talking about how do y'all
It's not.
Yeah,
I'm sorry, ask your question first.
Yeah, and so that answers the guy for the family that doesn't borrow money; they pay cash for everything. What about the other situation of someone who has a few credit cards? They just bought a house, so their mortgage to equity debt ratio is skewed in a negative way. I mean, how do you filter that out?
Well,
Well, first of all, again, they don't use the same factors that credit scores do. They look at different factors that are better predictors of risk.
Right.
Too many credit cards, balances that are way, if you keep increasing your credit limit because you keep busting the cap that you have on credit cards and that kind of thing, those are risky credit behaviors, and those are the types of things that insurance scores take into account as opposed to credit scores.
Thank you. I appreciate you clearing that up. Secondly, we know that a lot of the cost of claims is when they evolve into a lawsuit. Yesterday in Jude A, someone testified that Louisiana is a judicial hellhole because there's so many lawsuits filed. In comparison with Miami and Florida, there's of 100,000 people in Miami, there's 118 lawsuits filed. And in New Orleans, it's over 800 lawsuits are filed per 100,000 people. What do you think causes the high number of lawsuits in Louisiana? Some people say it has more to do with the statute of limitations being 1 year in Louisiana, 4 years in Florida. Some say if we had a 10-year prescriptive period in Louisiana, you'd still have 800 lawsuits filed per person for 100,000 people. Which group are you closer to in that analysis?
Well, I think it's probably a combination of things. I would not point to one single law. Extending prescription might, in fact, reduce the number of lawsuits. I'm not sure whether it would or it wouldn't. The challenge on the other side of that as a defendant is how do you defend a case if the first notice you get is 23 months after the incident? How do you go back and get witnesses and evidence and those kind of things? So I think there's a yin-yang on the prescription period.
Okay, well, how do folks do it in Texas with 2-year prescription? Do they have higher rates in Texas or lower rates when sometimes they don't find out till the 23rd month?
Yeah, and they don't. Well, our rates are, as I think you know, some of the highest in the country. So that's the reason that Representative Talbot threw all of the outliers in one bill. We're an outlier with prescription. We're an outlier with direct action. We're an outlier with the jury trial threshold. We're an outlier with the medical cost transparency. So his point was the areas where we're doing things different from other states, some of these got to be part of the problem. So let's put them all in one bill.
Right.
And we support that. And I think most of the folks in the insurance and business community support that. Even though we have some concerns about the extension of prescription,
right,
maybe it'll work. But because we have some concerns on the other side of the prescription extension, we'd like to see some of these other things tweaked so that as a package it works together.
And I appreciate that. So once again on the statute of limitations, we're only one of 3 states that still has a 1-year prescriptive period. Some states have moved all the way up to 6-year prescriptive period. Utah, Florida are at 4. About 24 states are at 2 or 3 years or even more. Have any of those states, when y'all go to national conferences, do they regret extending their statute of limitations?
I've never had a discussion with anybody from any of those other states about prescription.
Have you seen any state try to move back to 1 year to lower rates?
Not that I'm aware of.
Okay. And lastly, in talking about just in global, reducing rates, we talk about billboard advertising for attorneys, and I think most people are against that, want to limit that in some form or fashion, and that was talked about yesterday in Jude A. Senator Long had a wonderful resolution that brought that to light and asked the Bar Association to do a 10-year review. I guess my question is on the flip side of that, on the other side of the coin, when an insurance company markets, and when they buy TV or when they sponsor the net that catch a field goal at the LSU game, or if they do billboards and things like that, how is that equated into the premium? How does that trickle down to the premium cost? Do y'all know that offhand?
That is an expense of the insurance company, is included in their overall expense load in the insurance premiums, certainly.
Do you know how much they spend on that and how it affects premiums?
I don't think Mr. Piazza may have a better idea. I don't think that it's a significant number overall in the premium load.
Okay. So their advertising doesn't affect premium load?
It certainly adds a little bit to the number, but I think it's a very small amount relative to the overall premiums, is my understanding.
Yeah, we have Mr. Piazza address it if you'd like to.
Rich Piazza, Chief Actuary at the Insurance Department. The expense of advertising, marketing, that's all part of the premiums we pay for insurance. It is included. So, but that's at the insurance company level. So, different companies have different budgets for marketing. It is not a huge percentage of the overall premium, but it is one that's is definitely measurable. Single digits probably for all of their advertising and marketing, but it will vary significantly by company depending on what they do.
And that's something that y'all look at when you say whether or not they're in line or out of line for passing those costs of advertising on to the premium payer?
We do not dictate how much money a company spends on marketing and advertising. But what we do is we look at it and make sure that if they historically spend that amount, that's the amount that will be loaded in going forward. In other words, we look and make sure that there's a pattern of spending that much money, and that is what they can, if they propose to do so, put in their rates for the next year or going forward. We do not allow companies to arbitrarily tell us, for example, that we're going to double our budget on advertising and include that going forward because it hasn't been real. We don't know whether they're really going to do it or not. So we stick to historical paid amounts in this particular category, and they can use that for their future rate levels.
Thank you.
We do have a couple of late cards. Just wanted to read those real quickly. Ms. Phyllis Perrone is here with Louisiana Insurance Conference in opposition, does not wish to speak. And Devontae Lewis is here with Louisiana Budget Project in support of the bill, but does not wish to speak. Tom, would you like to?
Sure. I think Tom Clark on behalf of Allstate. I think that Rich, Kevin, and Jeff have pretty much handled everything. The only thing I'd like to add, maybe to add a little more complexion to this, is I represent a group of companies, and we engage with Rich when we make rate filings, and the department's role here is to be have definite oversight into the manner in which premiums are structured. So these are confidential conversations that happen between the regulated entity and their regulator. And each company has a proprietary model by which they set rates, and the insurance score is an integral part of that. Believe me, it is a lot of dialogue happens with the department as to what they will accept or not accept, or what the basis is, and so this is not a rubber stamp process by any stretch of the imagination. The insurance score is just a mechanism that we use and that we need to use so that we can, refine the rate for our consumers in the best way possible in a competitive market. Insurance is business. Insurance is a business that supports businesses and supports individuals, and this is just the way we operate our business. And so we trust the process as it is, and there are certain things that obviously we want to acknowledge and appreciate evolution in the way that we're regulated, but this is one where we feel that our ability to compete effectively would be constrained if the insurance scoring component was removed.
Good, thank you. Senator Johns has a question.
Thank you, Mr. Chairman. Members, good morning, and gentlemen at the table, good morning once again. There is a way to lower rates. Very simple. Just lower our claims ratio. Now, how do you lower claims ratio? I mean, it's a matter of dollars in, dollars out with any business. I don't care if you're in the insurance business, you're in the retail business, if you're in an attorney's office or whatever. You've got to have a certain amount of dollars in versus dollars out in order to make a profit to stay in business. And I don't know that. I mean, there's all kind of answers. We've discussed them all here this morning. But I don't care if you want to call it cost shifting, cost sharing, whatever. It's got to come from somewhere. So I agree with you, Mr. Albright, that when you change this model, somebody's got to pay for it somewhere. It's got to be paid for. And so the better risk going to end up paying for the worse risk. Look, I'm in the business. I think everybody in this room knows I'm in the insurance business, and then nothing I want more than see rates go down. I mean that. I'll vote for anything that I honestly can think that rates will go down. I just don't think that this bill is going to lower rates in any way, shape, or form. So, but if we can do something about impaired drivers, if we can do something about distracted drivers, we can do something about litigation, if we can do something about bad roads out there. I mean, there's a million factors that we can talk about that's going to ultimately lower rates. But I see companies that come into the state all the time. They try to buy the business. We're going to give a real cheap rate, and guess what? 1 year later, Mr. Piazza, you've seen those. They're back at the table asking for a 22% rate increase in 1 year because they got their clock cleaned in that first year. So I've seen companies come in and not underwrite properly when they write the policy. They sell it at a pretty darn cheap rate. And what do? At the very next renewal, then they properly underwrite it. Now, I've lost business at my agency, and people call me a year later and say, wow, that company I went with last year, they went up 20%. At some point in time, they've got to get the proper rate just to keep their doors open. So Senator Luneau, I know you worked hard on this. You're a good lawyer, by the way, Senator Luneau. If I need a good lawyer, I'm coming to hire you. So, but anyway, I know we have some more questions. So, thank you, gentlemen.
Thank you,
Senator Marsh, for a question.
Thank you, Mr. Chairman. I guess it's directed at you, Jeff. In your comments, you talked about the base rate and how the underwriting is done, but just for the record, not all companies, and you represent independent agents who represent a lot of different companies, but not all companies use the same underwriting criteria. Are there not some companies that maybe don't use insurance score at all?
There are some companies that do not use credit scores, or insurance scores. I fall into the trap. There are some companies that do not use insurance scores, but a significant majority do.
I understand that, but that is when you talk about this base rate, and I don't want to confuse the committee because that's not not every company uses the exact same underwriting criteria. So my point is there are ways to get lower rates, and that's to shop your insurance. So what happens with one company A may not be, and of course, and I know as an independent, representing independent brokers as opposed to maybe captive agents like Allstate or State Farm, you still have the ability to shop that and to say, well, my rate was too high, and they said it was because of my credit score. Well, I'm going to go over here to XYZ company and see what it may be there. So you do have an opportunity there through competition to actually lower your rates.
Absolutely, Senator Morris. And just to clarify the point that I was making on base rates is, as I mentioned, a significant majority, 75, 80% of people don't have tickets, accidents, or claims. So you can't rate them on experience. They all have good experience, but they're not all the same drivers. A young, male compared to an older, mature, married driver are two different risks. So you have to use some group of factors to differentiate those 75 or 80% of the people that don't have tickets, accidents, or claims. But virtually every company that I've ever heard of always apply the experience to whatever their base rating is. A bunch of them use credit scoring, some don't. They almost all use what type of vehicle. They almost all use the garage location because major metropolitan areas have higher claims experience than more rural areas. So whatever factors they use, they have to differentiate rates for those people that don't have tickets, accidents, or claims. But almost every company I've ever heard of do use the experience to then adjust that rate up, because if you've had those tickets, accidents, and claims, you're a higher risk.
And one other, and this is probably predominantly Mr. Cunningham, you mentioned earlier, and you haven't really testified yet today, and that's the 2005 or 2006 legislation that we did here with Senator Lambert Boissier's bill, that was an in-coil model.
Yeah, that was an in-coil model that we passed in 2005. 2005 because, quite frankly, I think in the last probably 3 years before that, we had credit scoring or the use of credit bills every year in which we were defending the use of credit. This is the same conversation basically that we had back in 2005 or prior to that, and then up into 2005, in which they developed a model bill as a result of the more and more companies starting to use credit information. And at that point, it was unsure as to whether or not it was why it was so predictive of claims of potential claims. What we found since 2005, and the number of studies that I provided you last week, all indicated that it is extremely predictive. But in 2005, you came up with a pretty good piece of legislation, quite frankly, that answers most of the questions that that I know Senator Gaddy raised, I think Senator Luneau raised last time, relative to when you do use credit, you have to be able to use it in a very a manner that does not adversely impact the people who are who are applying for insurance. And so you've got a number of safeguards in this bill, what can and can't be used in that insurance score, why it differs from credit score, as Mr. Albright said earlier. You've just got a really good piece of legislation, so much so that 28 other states have adopted, 25 other states at least have adopted it.
And I think that's where I was going. I think there are other states many states that use credit scoring, but many other states I think have adopted that INCOIL model, and it's been vetted by INCOIL. I'm a pretty active member of INCOIL. Right. And so I know that it's been revisited by INCOIL since it was originally adopted, and I think it's been revisited several times. And we always look at the model and say, it seems to be working quite well in other states. And so in the past, I would say 5 years, INCOIL has not revisited it because they think that we have a good model. So we are using it in other states. So it doesn't necessarily drive the rates here because in 25 other states we've adopted the same model.
Yeah, and just to be clear, 25 other states have adopted the INCOIL model. I think 46 or 48 states allow for the use of credit information in their underwriting. So I don't want you to think that half the states don't allow the use of credit information. They just have not adopted the exact model.
Many of them have taken the model and used it and changed it for their state policy or how they.
That's accurate. Yes.
And I think possibly even, and Mr. Piazza may have, doesn't NAIC have a model?
Yes, I was going to add that NCOIL is, I think, was in the forefront of creating a model along this lines, but NAIC also has a model that is very similar but yet different in some key ways, and many states have adopted the NAIC model.
Thank you, Mr. Chairman. In conclusion.
Senator Lambert.
I think everybody's concerned with rates. So the fact that we have mandatory insurance, does that actually raise rates or lower it? Does that have an effect?
I wouldn't have an answer on that as far as the insurers and what. Mr. Piazza.
Well, I guess I'm not sure whether it would really make a big difference. However, I would point out that to the extent, and I think Mississippi and there's some other states that have over the years had very high uninsured populations. I know I would buy uninsured motorist insurance, and my rates would go up significantly. So it'd be somewhat of a trade-off. So whether the average rate would go up dramatically or down dramatically, I wouldn't say. I would expect it to be somewhat neutral because we'd be shifting, for those who do buy insurance, the cost of the uninsured motorist would go up.
You better have uninsured
motorists. And my
motorists.
liability might go down, especially in Louisiana when you have a no pay, no play type law. There is some savings, but there are also costs associated with the shift as more and more people become uninsured when you don't have mandatory insurance requirements.
And I guess maybe this to Mr. Albritton. You say our claims rates, or payout and bodily injury is higher than most states, although our accident rate is the same. How does that Does that have anything to do with the fact that maybe we have low insurance rates, and now that we're, people who have UM, have to draw on theirs? And I guess if we raise the insurance rates, would that have an effect on maybe lowering our, insurance rates for everyone else? Raise the limits, rather. I mean, yes.
Okay, I'm sorry.
Yeah,
Yeah,
I was
I wasn't
kind of
following you.
confused. I'm thinking, but I'm not saying what I wanted to say.
Okay. I can't speculate as to what that would do. I know our minimum limits are lower than a lot of other states. We're at the low end of minimum limit coverage compared to other states. What the impact on the experience and the rates would be relative to that, I can't speculate.
All right, and I guess when our claims rates are, we're paying out more. I mean, is that taken into consideration?
Just to
the
clarify,
UM?
just to clarify, the numbers that I gave you earlier, the accident rate is how many accidents do you have per 100 vehicles? So it's
Okay.
a relativity, okay? And we're slightly higher than the national average. Again,
Per
it
100
seems-
vehicles.
Per 100 vehicles. So it seems to me what we want to do is stop being at the high end and get down in the middle of the pack somewhere. And we're there with the accident rate. We're there with the property damage claim rate. How often per 100 accidents, how often do we claim that our vehicles are damaged? We're right there in the middle of the pack. But the bodily injury claim rate, how often we claim that we're injured per 100 accidents, is much higher than the national average.
Okay. Does that take into consideration the bodily injury claims? Like, if I had higher
As
limits,
far as I know, that is a separate experience because the bodily injury claim is a straight-up liability claim. I'm making a claim against you because you've injured me. I think they keep, as far as I know, the claims are kept separate from that.
all right, so a claim, is our claim higher than other states?
I hadn't really looked at that closely. My appreciation, and Rich may have better information than me, my understanding is that our uninsured motorist rate is somewhere around 14 or 15%, which sounds high, but it's not way out of whack compared to other states as far as I know.
Okay, but the only thing is if we're making more claims against our uninsured motorists.
Now, underinsured motorists
Yes.
is probably a big issue, and that may be an area where, as you suggested earlier, if you raise the minimum limits, that may reduce the uninsured motorist exposure, but of course it would also increase the rates for liability coverage because you're buying more coverage.
But would that have an effect of reducing the overall rates?
My guess is it would increase the overall rates because you're forcing, I think, something in the order of 40 or 45% of the population carries the minimum 1530 limits, and you're going to force all of them to buy whatever you raised it to, 50,000. So they're going to pay more because they're buying more.
In addition, as it becomes more unaffordable,
Then the uninsured motorist
then
may
your
go up.
UM portion goes up.
I may ask Mr. Pizzazz if you can comment on that. Is there any look at that? Anybody looked at that to see whether or not if you raise the rates, that would actually lower the liability and raise the insurance
Raise
rates?
the minimum
Minimum,
liability requirement. Well, we can go back to when it was 1020 and we raised to 1530, and there was a 15% increase in the overall costs associated with doing that for those people who were at that minimum limit.
But what about everybody else?
They stayed the same, roughly.
If
Because
they-
it's a liability coverage. Uninsured motorist rates, well, because ours is a little complicated because Jeff pointed out that we have uninsured and underinsured kind of all combined into the same coverage. And it would move, I couldn't tell you how much off the top of my head.
All right, ours are combined, like we have underinsured, uninsured. Other states don't do it that way?
No.
How do they do
Some
it?
states don't. Some states, well, as a separate coverage. I'm not sure, and I'm going to defer to the attorneys at the table. Attorney, the two of you. I'm not an attorney, so I don't know exactly how this plays out during the course of a claim with respect to underinsured and uninsured. I think underinsured would come into play whether or not the individual is uninsured to begin with. It's sort of a I guess I always thought of it as a stacking of coverage.
I can't give you any quantification, but I know that there are significant differences between the way different states handle uninsured and or underinsured motorist coverage. As Rich just stated, some companies allow stacking of limits. It's a hodgepodge of different, but I can't tell you how many states do like we do and how many do, in different ways. I know there are significant variations.
All right, I guess I'm kind of confused to how you can have a different variation, because if you're underinsured, you still go against your uninsured motorists, and even if the person is uninsured, you still go against them. So they do something different to differentiate between those two?
Again, I've never studied it, but my understanding to talking to some of my counterparts is that there are some differences in different states as to how they handle that. And I can't really tell you too much more beyond, I know there are some differences.
Okay, does that go into the claim, to saying how much claims are? Does that have anything to do with it? Why maybe our bodily injury rate is higher?
Well, again, I think
claim rate?
That would be the separate experience of uninsured and potentially underinsured motorist as opposed to the BI coverage. The BI coverage is straight up third-party tort liability.
Okay.
Yeah, and I'd like to just echo what Jeff said. In terms of the statistics he mentioned, where the bodily injury claim frequency in Louisiana is roughly twice as high as it is countrywide, whereas the accident rates are about the same. It does not get complicated by uninsured or underinsured coverages. That's a completely separate coverage when these statistics are generated.
Okay.
Okay. By the way, Mr. Eric Berger has safely navigated his way to the Capitol without a claim, and he's with Gray Insurance Company, and he is in opposition to the bill. Senator Ward.
Thank you, Mr. Chairman. Just a couple more things. The first thing I wanted to say was Senator Marsh brought up the point about shopping around, and ironically enough, my cousin last week, we happened to be talking about insurance, and he said for like the third year in a row his rates climbed, so he got his insurance guy to shop around for him, and he got the same coverage and everything else just by shopping around for $2,966 less, just by simply shopping around. So apparently that can make a big difference if you simply just look around. And y'all may or may not be able to elaborate, but we've talked about credit score and driving history and all those things. Can you tell us how those things are weighted? Like if I've got a clean driving history but a low credit score, or I've got a DWI but a really high, well, we won't call it credit score, a insurance score, whatever it might be, a DWI but a really good score. How are those things weighted? Which, does one completely outweigh the other, or is one weighted heavier than the other?
Mr. Piazza may have more information. My experience is that it varies from company to company. They all use different formulas as to how they balance those different factors. And so I can't give you any idea of relativities. I can tell you that it varies significantly from company to company.
Mr. Albart's correct with respect to the variation by company. Each company will create the rate relationships between these characteristics based on their own experience, and every company often has experience that can be significantly different. What I would say is that what you're asking is within the actuarial profession, it's a very complicated calculation. They use what they refer to as models, specifically generalized linear models. These models take into account the interrelationship between these characteristics. So it is intended to remove overlap with respect to, for example, the predictiveness of credit versus the predictiveness of driving history. The two are looked at in combination in these models, and the model will produce relationships or relativities that will take into account the interrelationship and and it will remove that so that you're not overcharging or duplicating the charge in one factor versus having it duplicate in the other. It takes the duplication aspect out. But it is a very complicated actuarial methodology that's used, and it's used almost exclusively across the private passenger market and, for example, the homeowners. And it's used often in commercial, but not quite as often there.
We seem to get that answer a lot. It's complicated.
Well, it is, and the insurance companies. I'm not convinced all insurance companies that make filings in our state can understand it well enough to actually explain it to us regulators when we ask questions about it. But our job is we dig until we get a good understanding of what they're doing. And most companies today, when this first started, it was like pulling teeth. It was hard to get answers to some of these questions.
And I know y'all are in a difficult spot too, because you're kind of having to answer these general questions on behalf of different insurance companies that operate in all sorts of different ways. But I guess I'm just trying to get a grasp for if I walk into an insurance agent's office and I've got if I had two car accidents, but I happen to be pretty well off, and so I want to insure 3 vehicles, 2 homes, and a boat, and I've got a pretty good insurance score, in fact, a very good insurance score, or I walk in and I've got completely clean record, and I want to insure 1 vehicle that's 10 years old. Who would be looking at the better rate?
Senator Ward, can I comment on that? Representing independent insurance agents, most of my members have multiple companies that will write almost any line of coverage that you're looking for. So if you have somebody that's looking for personal lines insurance, all those things that you mentioned, they'll have 2, 3, 4, 5, 6 different companies that will do that. And that's one of the things that we do as independent agents is we quote those different companies, and the variations can be substantial. And so as somebody said earlier, I guess you made the point,
that's why it's
cousin or
important
somebody
to shop
said,
around.
Shop your insurance
Gotcha.
period. And my suggestion, you don't want to shop it every year, but every few years, particularly if you start getting several increases, then shop it around a little bit, and you may be surprised the variations. And it's hard for us to explain, well, why is this one here? Believe me, as independent agents, one of our biggest challenges, well, I quoted 5 prices. They're here, 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 and here. You want to go here. I can't tell you why those are up there. As Rich has said, it's complicated, and we have an idea of the basics of it, but I can't.
So the best advice we can offer is shop it around. Okay. Thank you.
Sorry, I can't give you any
more
that's specific than
that's
that.
fine.
Mr. Cunningham, we weighed in on you pretty heavily. But if you have further comments, we'd be interested to hear them.
No, the only other things I wanted to say that I'm not sure if it was said as clearly is that the whole part of an underwriting system and the information that we get in the underwriting system is to make sure that the rate follows the risk. So if somebody has higher risk and we can prove that and we can show that, it's important for us to know that and make an appropriate rate for that particular risk. This underwriting system provides us the opportunity to do that. Credit scoring or insurance scores is a way that we can do that. I know it was said that it's been said a couple of times relative to whether or not a low credit score is indicative of income. Most of the studies that I brought up last week all indicate, at least I know the Georgetown, Texas, and I believe Arkansas, all indicate that low credit score is not necessarily a proxy for income. So just don't assume just because you have a low credit score you have low income. I think that's an important distinction that you need to make. And lastly, I'll just end with the fact that, we've gone through this before. 2005, you've done it. You came up with a very good law. I think we were maybe one of the early adopters of the in-coil model. Most states have followed us or followed the in-coil model. 25 states have done it, and that it is an extremely important underwriting tool that companies use to make sure that, one, that they don't that they can remain in the state and offer insurance to your constituents. So I'll leave it at that. But I appreciate the opportunity for letting me
And
speak.
Mr. Piazza, we would really be interested in any information you might have to give us this morning in general, or specifically over Bill, Senate Bill 89. Is it 89?
Rich, do you want to come sit over here?
And
we all want to get up.
Thank you, Senator. And I just want to emphasize, I'm not here in support or
we understand
against
that.
this bill. I'm here
information
only,
only,
for
but we
information
appreciate the information.
only.
We need a lot of information.
Well, a lot of things have been said during the course of this, and I don't want to dig too deeply into it, but I will emphasize just a couple things. The an insurance company's, what they charge for their rates has to be in balance with what they're paying out in their claims and expenses, and there has to be a fair profit. Otherwise, you won't have an insurance affordability problem. You would have an availability problem. They won't write. They won't be here. So given that that balance exists, and I'll just use a very simplistic example to try to explain why rates overall aren't going down, because of a shift, if you would, between who pays more or who pays less because of a single rating characteristic. Let's say you have 3 policy holders, and each one is charged 110 because they have poor credit, and one is charged 90 because they have good credit, and one is charged $100. The insurance company needs to collect, if you add all that up, $300 in the end, because there is no change in the overall risk or what they're going to pay out in claims and expenses. That does not change by simply removing credit. What would happen is that the one person paying more because of poor credit would go down to $100, which is the average, and the one paying less would go up to $100 to compensate for that. The insurance company would collect the same amount of money overall. There would be no change because the claim side, nothing has affected the fact that claims are occurring. You have not reduced the number of claims. You have not reduced the severity of those claims. And unless that happens, and there was some discussion here, and I know over the years there's been a lot of discussion in this committee and others regarding how do you lower the overall rates that we pay in Louisiana. You can't do it unless you take something away from the claims or the expense side of this equation. You can't take away the profits, because if there is no profit, companies, I'm back to, you don't have an affordability problem, you're going to have an availability one. So the only way of reducing rates will be to take something away on the claim side. And once that's done, companies will be, when they file for rate changes in Louisiana, will be forced to recognize it, and rates will go down, the premiums they charge. You can go back, actually, I won't suggest that that's something you need to do, but back in the 90s, during the Governor Foster's era, they had reforms, and there was a mandatory rate reduction for some of those reforms that occurred. It was a 10% reduction, but they had significant reforms that went in place that lowered the cost of insurance on that side. And as a result, the premiums went down. They temporarily stayed down. As I think it was Mr. Cunningham pointed out, you have inflationary pressure that is always going to raise rates. So just because you have a temporary reduction doesn't mean they're going to stay there. They're going to creep up again as the cost of the claims, the medical, the wages or the cost of vehicles to repair are all going to be driving those up.
Take a moment to answer Senator Gaddy's question on that issue.
Thank you again for this information. It's very helpful. And one of the questions I was going to ask you is, what do you look at? What do you look at when you're looking at insurance for me? You kind of said that in your opening. What you said was, we can look at claims, we can look at this, we can look at the cost, but we can't look at profits. And I want you to kind of go into that a little more. I mean, surely y'all look at their profits, what they spend on advertising, what they pay their people. I mean, surely when y'all look at their financials, you look at, I mean, they look at my credit score before they write me a policy. Surely y'all look at how much they're spending on advertising and what their profit margins are. I mean, I just want you to make sure. I mean, I don't want to really correct you, but I mean, you kind of blew through that. I want to make sure that y'all do look at their profits before you allow them to.
I'll back up a second. And the answer is yes, we do. However, a couple of things you mentioned, like marketing, it isn't considered profit. Profit is the return. Think of it as a stockholder, a shareholder. It's the amount that you would return to them for the investment, the expected return over time for them providing capital to the insurance company.
But if they say we're only making 5%, but they spend $6 billion on advertising, you would say, hey, well, maybe y'all could cut your advertising a little bit, right? I mean, would that be something you would regulate them, or would you say?
We look at the advertising budgets of these companies. We do not have statutory authority to tell a company how to operate their company and how much they should spend. What we do look when these come in is the actuarial reasonableness of what they're asking to be placed in their rates for the expenses you mentioned, for the expected profit provision, the return on the equity they put into the company to operate. The claims activity, and usually claims, you can break it down, the expected severity and the frequency of accidents. That's all being considered.
I understand that y'all consider claims and cost of claims and suits filed and what they have to pay their attorney to defend a suit and all this. I understand those are the things you look at, but earlier you said, well, profits, we can't look at that because if it's not profitable, we have a bigger problem.
We do look at profit. We do look at profit going forward.
Could you tell us how you look at their profits, what percentages are okay in Louisiana for profit, and whether or not, because you know, a net profit is only determined after expenses are examined. And so what expenses do you allow in that equation to say this net profit is okay?
Okay, we don't look at the historical net profits of a company. And there are some states that do. Florida and California have excess profit laws where they'll look back and say you made too much money, now you have to give money back to your policy. There are very few states that have laws of that nature. We do not have one in Louisiana. What we do is look historically at the expenses for that company. We do compare the company to the industry as an average, and we expect them, I mean, there's going to be variation, but we do expect them to be kind of in the same ballpark with respect to how much they're spending on average for a particular line of business. The profit provision, we have if you would, historically, and it seems to have worked, that there is a 15% return on equity that's in the company. So equity is an annual statement. It's a statement. You can find the equity companies have.
Correct.
And you can say, well, if you had 15% return on that equity, this would be reasonable for this industry, considering how much risk there is in the insurance industry. And we work with that number, and we determine from there how much of that should be reflected in the premium. And usually it comes down to around 5 to 7% of underwriting profit in the premium will produce, on average, a sufficient return to make shareholders and everybody else happy to be doing business in our state.
I just wanted to clear up. You do look at that.
We do look at it
because earlier
very much.
You kind of categorically said we don't look at, but I know your office spends a lot of time looking at profit margins and things like that.
We do.
I wasn't trying to battle you on that issue. I was just saying, you said we can't look at profit; we have to look at claims, and I know the push here is to look at the judicial system, claims history, and those things, but I don't want to just gloss over the fact that y'all do look at marketing profits and those things, and to make sure we're on a good even kill the national average.
We do, and an oversimplification is that we look at everything an insurance company is spending money on or expects to earn in profit and investment income and all that. We look at it all, and we make sure that it's a reasonable amount based on historical averages for that company and for the industry as a whole.
Thank you. And I know you mentioned some reform that was done during the Foster administration. It was groundbreaking. It was wonderful, thought out. It kind of brought us to the front of the battle. One of those was no pay, no play, and that I think that had a rate reduction tied to it.
Mandatory 10%.
Mandatory 10%. How did y'all enforce the mandatory 10% reduction, and what kind of tail did it have on it, if you could tell the committee?
Well, the enforcement actually was quite easy because the legislation said the industry had to do this, and they had specific dates in mind. I don't recall the exact date, but say 6 months after the legislation passed, I think it would have been in August, maybe August 15th, that it was signed into law. Then by, let's say, the end of the year, every insurance company that did business in the state had to lower their rates for bodily injury liability and adjust their rates for uninsured motorists because of the no pay, no play to account for that legislation. So the insurance department made sure, and we notified the industry, and anybody who did not file, we reminded them, and every company that had rates that would have been affected by that legislation filed with the insurance department. We reviewed it to make sure what they were going to do was reasonable, apart from the mandatory minus 10%. That was easy to figure out whether they were doing it or not.
Right.
And they all did it. So our job was basically simplified, and since the legislation laid out a timeline, we monitored, if not held the hand of some companies, to get them in to make sure they did what the legislation said they had to do.
And if we put that in a statute today and we said a mandatory 10% reduction, is that something your office could handle and police for us, or is that?
There's no question we can handle it and police it, as long as, and especially if the time frame, if that were to be put in any legislation, as long as there's sufficient time frame for the industry and the department to make the filings, to make the adjustments, and the department then have time to review them.
And but you said those were temporarily downward trends, and
it was
eventually
a one-time deal. Once if the rate's up here and you by legislation you force you provide a reason for it to be lowered, at that point in time, all those inflationary components that drive insurance costs, what we're paying for, they all start to creep up. Those rates will have to go up accordingly. And
that reform from the 90s is that was bigger and more comprehensive reform than anything we're trying to do this year, wasn't it?
That's a judgmental call. I don't know if it's really more or less. I know it started out to be a lot more movement in the law, and I think a lot of it got dropped by the wayside before the legislation passed.
Thank you. I didn't mean to interrupt you. I just want to make sure we clarify that before you go on. Thank you for being here today.
And just in case you hadn't noticed, Elvis is in the room. Bubba Henry just slipped in the door and to grace this committee. Welcome, Mr. Henry. Good to see you this morning. We can't repeat everything that's gone before you, but we'd like to. Senator Johns.
Thank you, Mr. Chairman. I'm going to be very brief because I know this has gone on with good debate. But I think the most important thing you said at this table this morning, Mr. Piazza, was about creating an availability a problem. That actually happened in the homeowner market a number of years ago, and that's where the Louisiana Citizens Plan had to be created. And we ended up, it got down to we only had maybe 2 or 3 companies in the state that would write a policy, and particularly in South Louisiana. I know in my agency, I went over 10 years, I could not write a homeowner policy where I live, and I'm 50 miles from the coast. But Citizens Plan ended up with over 100,000 homeowner policies on its books, thanks to the efforts of the department. As more companies came in and started buying off those policies from Citizens, I think we're down probably below 30,000 policies today or something. But there was an availability issue, and that was a reality. That happened.
It was 170,000 policies.
170,000
was the peak. It was close to 170.
Wow.
And you're correct that availability becomes an issue in insurance companies because they cannot make what they consider a fair profit,
right.
Considering the risk. Quit writing. It happened also in the late 80s with workers' comp, which is how we got LWCC to take. We had 80% of all the workers' comp policies were in the assigned risk plan back then. And this was a national problem, not just in Louisiana.
Right.
And then we had automobile was the same thing, where we had a crisis in the early 90s because of insolvencies. Champion's a good example of that, largest insolvency we've ever had in this state.
That was a big
and 25% of the business was going to the assigned risk fund. Companies just refused to write because they didn't think they could get a fair shake on the fair premium to be charged, and corrections had to be made.
Right. Okay. Thank you, sir. Appreciate your work.
Thank you, Mr. Piazza. I don't have any more questions for you. If you have any other comments, we certainly entertain them.
No, I think unless you have questions, I think everything's been said.
Good. Thank you.
Thank you, sir.
Senator Luneau, closing time if you're ready.
Well, first of all, thank you, Mr. Chairman and members, for this debate on this really important issue. Some people say we're wasting our time. We shouldn't have spent this much time on this, but I would suggest that this is exactly what we're supposed to do, and I very much appreciate you all indulging us and let us have this important conversation. Let me start out by talking about the things that weren't mentioned by my worthy opponents who sit at this table, and that's the widow tax and gender. I think those are two things that the industry can live with. This bill is not just about lowering rates, and I do believe that it has a chance to help lower some rates. It's not, as Senator Ward said, it's not a silver bullet. It's not going to fix the problem. It's not, but I think that it's reasonable, and I think it has a chance to help us lower rates. But you know what else it's about? And to me, the most important part of it, it's about fairness. It's about the people that really are the risk being assigned the proper risk to them and paying their fair share. That's a big component of it. We centered on the issue with the credit score, so let's talk about the credit score. It's been said by the opponents at this table that credit scoring is the biggest problem that they have in this bill. They talked about the 12% of people that are charged a higher premium because of the cost shifting dealing with credit scoring. And understand, and Mr. Albrecht made the point, this is not about an Equifax credit score, whatever. He's exactly right. It's not that. It's about credit scoring that the insurance companies do. And we heard about the Georgetown University study, and that was and one other study that Mr. Cunningham referenced. That's really the only data. I read those. I looked at them briefly. I didn't read them word to word, but I looked at them. I couldn't discern some of the points that he made there. For example, they don't point to any empirical data. All of this is data that's maintained with the various insurance companies, and it's proprietary information. So everything is, this is our information. We're not going to tell you how we do it. The insurance commissioner can look at it with us in private, but you got to trust us. I understand that. There's some data in some industries that has to be proprietary, but at some point in time, with a mandatory product that Louisiana citizens have no choice but to buy if they're going to drive, there needs to be more sunshine. We need to be able to look at this a little more. It's been said that the only way to lower cost of insurance in Louisiana is to reduce claims. And that's what the problem they have here. They've indicated that bad credit score indicate the increased likelihood of a person making a claim against their insurance company. But if you think about it, that's just not a good argument, because the insurance that we're talking about, the mandatory insurance in Louisiana, is liability coverage. If I cause a wreck, I can't make a claim against my liability insurance coverage. That's the other people that I've injured make the claim. So how does my credit score indicate that somebody's going to make a claim against me? It just doesn't. My driving record is a good indication of that, and how well I do. Now, I couldn't get my friends to agree with me, and Mr. Henry withdrew his invitation to have dinner at his house the other night, so he must be mad at me too. But I couldn't get them to agree with me on my amendment on the credit score. But I think my amendment on the credit score is reasonable. If you have a demonstrated, proven record that you're not a claims causer or maker, then maybe we ought to give you a little break. Maybe we ought to say, we're gonna readjust this. I love my friends at Farm Bureau. I have some dear friends that are Farm Bureau agents, and they're good folks, and they're good company. But they increased the price 133% in some instances because of credit scores. That's not fair. And is it just shifting it around? Do we have to have the same numbers to make all this work? Well, like Senator Gaddy said, insurance companies, they have to make a profit. There's no denying that. I understand that. That's the way business works. I own several businesses. I wouldn't be in those businesses if I wasn't making a profit. But a lot of times, that's a moving target too. We don't know what those numbers are. And it is complicated. There's no doubt about that. But if we look again at what we can do to help consumers to pay a fair amount, this is something that brings us there. I'm going to ask you to do something for me. I'm going to ask you on this committee to do what the industry did for me. If you don't like part of this bill, let's pull it. If credit scoring, if my amendment doesn't take care of that, if you're not convinced that a good driving record, proven driving record is better than a credit score, and you got to kill that part of it, let's kill it. But don't kill the whole bill for one issue. I'm not asking you to kill the credit scoring part of it. I'm just making that as a suggestion that if that's the holdup and if that's a problem, then we can look at that. These other issues, they need to be addressed. It's not fair to charge a person more in insurance rates because their spouse dies. That's not fair. That's not what we should be about in Louisiana. They had a problem with the gender issue initially because they said the argument they made to me was young male drivers tend to be more reckless in their driving habits than female drivers. And you know what? I understood that point. They made a good point. So I amended that. I think that's a good portion of this bill too. I think that's a fair compromise. So I would just ask for your favorable support of this bill, and let's move it on and see what we can do to get it passed.
Thank you, Senator Luneau. Senator Long, did you have a motion?
The motion is to object the bill, if that's what you're asking. I mean,
I thought you had a motion. But
yeah.
If you have a motion, and your motion is to report the bill unfavorable?
Yes.
Okay.
Yeah.
Defer or unfavorable? Defer. Okay.
Unfavorable.
Sorry. All right. As I understand it, Senator Long has moved to defer Senate Bill 89. Is that correct?
That's correct.
Okay. Is there any objection to that motion? Is there any objection? Without objection, there is an objection. Senator Gaddy objects. The vote will occur on the motion, which is to defer Senate Bill 89. The Secretary will call the roll.
Senator Gaddy?
Hold on just a second. If you want to defer, you would vote
yes.
Yes. If you want not to defer, you would vote no. Proceed.
Senator Gaddy? No. Senator Gaddy votes no. Senator Johns?
Yes.
Senator Johns votes yes. Senator Lambert?
Yes.
Senator Lambert votes yes. Senator Long?
Yes.
Senator Long votes yes. Senator Morris?
Yes.
Senator Morris votes yes. Senator Ward?
No.
Senator Ward votes no. 5 yeas and 1 nay.
5 yeas, 1 nay. The bill is deferred. Thank you, Senator Luneau.
Thank you, Mr. Chairman.
Good
Thank you, members.
discussion.